Hello everyone. I hope you are doing good, mentally and physically fit and fine, guys. So, first of all, thanks to SICASA, Chennai branch, that in association with them, we are taking a revision session for CA final audit. And yesterday there were some issues, technical problems, and so on. So, the streaming was not proper, guys. Don't worry. So what I have done is I've re-recorded the complete revision for you guys, and in just an 1 hour, yes guys, just in 1 hour, we have covered 800, 805 and 810, all the concepts in depth. Okay. So you can get this video on the SICASA of ICAI YouTube channel or Ravi Taori YouTube channel. Also, you can get this. Guys, again, I would like to repeat, this time we have made two different revision videos. One is all concept revision, and other is important question revision. Okay, 350 plus important question revision. So we made two things. Okay, and both of them are available in English as well as English. Okay, in both the languages it is available. You go to Ravi Taori YouTube channel, on the playlist you'll get the all concept revision of CFL audit in Hindi as well as English. 350 plus important question in Hindi as well as English. Make full use of it, guys. So some of the chapters of English were pending. So we are taking it jointly with the Chennai branch of SICASA. We're thankful to them. So guys, so 800 series in 1 hour. Now let's target chapter number 9, 10 and 11. Yes, that is, we are going to target 4,000 series, 2000 series and 3000 series. Let's target it in the minimum possible time, and tomorrow we'll cover again some more important chapters. And guys, we are covering all concepts. So that's very important that we are covering all the concepts here today. I know that we are very, very close to exams, but let's make full use of it. I won't be looking at the chat right now, because if I look at the chat and read them and answer them, okay, if I do this, guys, so it will take loads and loads of time. So I am not going to look at chat. So I will say that simply download the notes. Simply download the notes, okay, and go through with me. So guys, okay, just a minute, guys. Let's see, guys. So it is audit of related services. And when we talk about related services, we are talking about 4,000 series, and there are two standards in 4,000 series. Okay, let's see, guys, one by one. 4400 and 4410. So initially there is a case study given by the ICAI in the module. Remember, guys, this is all concept revision. We are going to focus more on which are important. All the important things we have marked in pink. We have given pink star. Okay, and You can go to Audit Guru Telegram channel, or you can go to Audit Guru Telegram channel, and if you scroll some messages, you will get, if you see the pinned message, you will get the soft copy of the notes. You can get the soft copy of the notes which are used for teaching here. Okay. And you will find that all the important concepts are marked in pink. So, initially in the module, they have given a small case study in which all the concepts of the chapter are applicable. It is just creating a background, nothing else. Come on guys, let's see. So we have related services. We know that we have standards for assurance and related services. Now, what do you mean by related services? In related services, same kind of knowledge and skills are required. Same kind of the knowledge and skills which are required in assurance, same it is required. Same kind of knowledge skills are required, but we don't give any kind of opinion, conclusion, any kind of assurance. And that's why it's called related services and not assurance services. There are two standards, 4400 and 4410. So, guys, we are through with a very simple introduction. We know what is assurance services. Anywhere where you report on reliability of the information. When you report on reliability of the information, guys, that is called as assurance services. And we comment about the reliability, and reading the report, people understand whether to show confidence or not. So it enhances confidence of the users. That is assurance services. Okay. And in assurance services, we know that we have most popular are audit and review. But then similar kind of knowledge and skills are required, but you are not giving any kind of assurance, any kind of opinion, conclusion, then they are called as related services. In assurance, opinion is involved. In related services, no opinion is involved. Okay. Let's see, guys. Now, as I said, there are two standards, 4000 series, which are applicable, which are there, 4400 and 4410. And 44, we are going to see the first one, which we are going to see is 4400 AUP, agreed upon procedure. What do you mean by this, guys? It's very simple. It's very simple. Okay. What do you mean by agreed upon procedure? So in industry, people will call us and they will tell us what steps exactly should be performed. They will tell us, okay, perform these 3 steps and perform these 4 steps. And whatever facts you come to know from this, just let us know. That is called agreed upon procedure. That means chartered accountant is not supposed to do planning, is not supposed to do his own planning, risk assessment, and deciding what procedure and examination need to perform. No. Chartered accountant doesn't need to decide what examination procedure need to perform. He simply needs to perform only those procedures which are agreed upon, which are present in the agreement. That's it. And he's simply supposed to tell the facts. That is called agreed upon procedure. That means only perform those procedures which are given in the agreement. That's it. Nothing else. Okay. Let's see an example, guys. Let's see an example. Suppose client says us, this is the list of the creditor, and you are supposed to perform 3 things. Only 3 things. First, match this list with the ledger. So this is the list. Simply match it with the ledger. See whether the account balances matches or not. Next, send external confirmation. Ask for external confirmation from these creditors. Their statements of accounts from these creditors. Okay. And see whether the balance matches or not. That's it. And next, see subsequent payments after year end in 3 months, how much amount is paid. That's it. Only 3 things. This is the list of the creditors. First, match with the ledger. Tell us how many has matched, how many has not matched. What's the difference? Ask for the external confirmation, statement of accounts from the creditors. Once you get it, match it, and then tell us how many matches, how many doesn't match. What the difference? That's it. And then subsequent payment for 3 months, and simply give us the factual findings. Whatever you come to know from these, simply give us factual findings. That's called AUP, agreed upon procedure. Guys, you cannot cram everything. You need to define and write things in your own words. So definition is pretty simple. In agreed upon procedure assignment, practitioner chartered accountant is supposed to perform only those steps which are given in the agreement, and he is supposed to report the factual findings which he came to know after performing those steps. Example, I have given you example of accounts payable. Accounts payable similar can be done for accounts receivable or any item of the financial statement. Now, the performer of the, it's very important, guys. It's very important. Performer of the agreed upon procedure need not be auditor. It can be done by any person, by any person. Okay. Let's see. So 4400. 4400 is for agreed upon procedure. It's going to guide us. Is going to guide us the introductory portion, guys. Introductory portion, not very important. It's going to guide us how to perform this particular assignment, how to make the report, and so on. Objective is pretty simple. Objective means what is the target set for chartered accountant as per the standard? What are we supposed to do? Okay, so we are supposed to do a very simple thing as per this particular standard. We are supposed to perform the steps which are given in the agreement, get the facts. Once you come to know the facts, make a report and give it to the users. That's it. How it is different from audit. There's a big difference. Audit versus agreed upon procedure is like assurance versus agreed upon procedure. Okay. The key difference is in audit and assurance services, auditor does risk assessment. He decides his own audit procedures which need to be performed. He designs this in such a manner so that he gets sufficient appropriate evidence, so that with reasonable assurance he can say whether the financial statement as per applicable financial reporting framework or not, whether they give true and fair view or not. That's it. But here only restricted, only limited steps are performed which are given the agreement. That's it, nothing more than that. So here we perform a lot of procedures. Here we perform only agreed upon procedure. In audit, ultimately we give opinion whether financial statements are as per applicable framework, whether they give true and fair view. But then in agreed upon procedure, we don't give opinion, nothing. We don't give any kind of opinion, guys. We don't give any kind of opinion. What we do is simple. We simply comment what are the factual findings. Let people decide. Let people decide what should be done. Okay, and we have discussed the examples also. Now we know in 4400 what is agreed upon procedure. The next thing is, when you perform this particular assignment, what principle need to be followed? Mandatory. It is mandatory to follow ethical requirements as given in Code of Ethics. The person who is performing, practitioner who is performing agreed upon procedure is supposed to follow ethical requirements, supposed to follow all 5 ethical principles, fundamental principles, which we discuss again a lot of time. Okay, integrity, objectivity, professional competence and due care, professional behavior and confidentiality, all the 5 principles. The most interesting being, is he supposed to remain independent? Now that's a very important point. Is he supposed to remain independent? The answer is, for agreed upon procedure, it's absolutely fine. It's absolutely fine even if he is not independent, guys. Independence is not the requirement for agreed upon procedure. And a very interesting thing, if the person is not independent, suppose he's dependent some kind with the client, he is a shareholder, he's a financier, he has business relation or any kind of dependency is there, any kind of close relation is there, it should be given in the report of factual findings. It should be given in the report of factual. Extremely important. So when you perform these, you are supposed to follow ethical principles. You are supposed to fulfill ethical requirements. You are supposed to fulfill ethical requirement, all 5 fundamental principles. There is no requirement to be independent. But if you are not independent, you lack independence. The statement to the statement should be given in the report that you are not independent, and you should also give the reason. Extremely important from the exam point of view. Very high chances that it will be asked. Now, step number 1. When you get this particular assignment, the most important thing is terms of engagement. It is extremely important. See, and as the name suggests, agreed upon procedure, we are only going to perform those steps and procedure which are given in the agreement. So it is extremely important, this assignment, that at the initial stages, a clear, unambiguous terms of engagement, letter of engagement should be framed, and it should be signed by both the parties, the practitioner and the client. What kind of things should be included? What kind of things should be included? Let's see. You should clearly specify the nature of the engagement. You should clearly say that it is agreed upon procedure. Only those procedures which are specified in the agreement will be performed. It is not an audit. It is not an audit assignment. People generally think whenever it's examination, whenever it is a examination, it may be audit. So you should clearly specify in the terms of engagement, it is not an audit assignment. It is not a review assignment. No kind of assurance will be expressed. Then the purpose should be specified clearly. First, explain the nature. Common sense, guys, nature, and then the purpose. Why this examination is conducted? Is it for internal purpose, so that we can, so that they can check their trade receivables, trade payables? Okay. Is it for the external purpose? External purpose, so that suppose it is for external purpose, so that information can be examined, and then it has to be submitted to the authority. So specify it is for internal purpose, external purpose, it's for some authority, it's for some third party, or it is done as per the requirement of some agreement, and so on. Explain the purpose, nature and purpose. Then identify the information. On which information procedure need to be performed? Is it account receivable, accounts payable, fixed asset, export sales, expenses, salary? Identify the information. Okay. And then the most important, specify the procedure. Exactly these four things need to be performed. And then clearly specify, it should be specified that this report is meant for only board of directors, or only audit committee, or only this set of people. It's only useful for them. It is not meant for others. It should not be distributed to others, or others should not refer. It's not meant for them. And even if they refer it, okay, it's not our responsibility. It's not our responsibility in any manner. So guys, it is pretty simple, that the most important thing is the term of engagement. You specify the nature of the assignment, is the purpose of the assignment, this thing will be checked, this is how it will be checked, and the report will be so and so people. Engagement letter should be framed and it should be sent. Generally, it is made by the practitioner. It is signed by them. 2 copies are there. 1 copy is it is signed by the client also. 1 copy is with the client and 1 copy is with the practitioner. And it's very important, so that there is absolute clarity. What are the responsibilities? What work will be done by the practitioner? What are their responsibility? What are our responsibility? It avoids misunderstanding. And most importantly, the procedure is there. The complete procedure is there, and clearly specified as report will be for so and so people and not for others. So guys, it's pretty simple. Let's freeze, guys. It's a lovely chapter. It's a lovely chapter. Chapter number 9. It's a new standards are there, and it is related services 4000 series. And we started with 4400. Now we know what we mean by agreed upon procedure and its example. Now we know about the general principle. We should be ethical, and it's not necessary to be independent. If you're not independent, statement should be given. Then step number 1, this term of engagement. What should be included in the terms of engagement? Now next is planning. Once you have list of procedure to be performed, you should make a plan of executing. Those steps. And as per what is written in the agreement, we may as per what is written in the agreement, we may go for simple methods of collecting evidence. We can go for simple methods of collecting evidence, guys. Okay, we know about this when we see how people are working. That is observation. Talk to people. That is inquiry. Take the calculator, recomputation. Sit in the calculator, analytical procedures, and so on. So we can perform. See, they may use the word auditor or audit evidence, but when they use the word auditor, they simply wants to say the person who is performing the assignment, the practitioner. Okay. Now, step number 3 is the most important step, is reporting. People feel that whenever it's a report, it's audit report, but then it's not report. It is report on factual findings, guys. Report on factual findings, and the complete format is similar. The complete format is similar similar to the format of the old audit report. In old audit report, there were only two changes. Two changes. First of all, the opinion section used to come after auditor responsibility. After management and auditor responsibility, opinion section used to come, and basis of opinion used to come. Basis of opinion used to come only when there is a modification. These were the two very big difference between the old format and the new format, and these reports are all based on old format. Okay, so in old format, the first thing we see is title. So here also you are going to get title. Here also guys, you are going to get title. Title will be report on factual findings. That's very important. Report on factual finding, not audit report, not review report, report on actual findings. Then the addressee generally are the people who are mentioned in the engagement letter, or these are the appointing authorities. And then introduction. Just like in any report, we have introduction. We covered 2 points in introduction. Identification, that we have performed agreed upon procedure on accounts receivable, accounts payable, fixed asset, export sales, specify the of so and so period or as on so and so date, identify the information on which examination is done, and what is the purpose, why it is being done. Is it internal purpose, external purpose, as per some contract or whatever it is, explain the purpose also. Once that is done, then you don't see a section which is like management responsibility. Why? Because in regular report, just below report, you have financial statement. So you have to specify, okay, these financial statements are below our report. We have not made it, management has made it. In this report on factual findings, there is no information after the report. No information after report. So here, it's very interesting, guys. There is no section which is like management responsibility. Directly, it is like auditor responsibility. And auditor responsibilities are very simple. A simple statement that auditor's responsibility is to perform procedures which are given in the terms of engagement, and he is supposed to perform his assignment, as per SRS 4400, and this is the list of the actual procedures we are supposed to perform. So it simply say that we are going to perform agreed upon procedure given in the terms of engagement, and we are going to perform this assignment as per SRS 4400. This is the list of procedure which we perform. And then after auditor responsibility, just like, see guys, the flow is same. Let's say we get opinion. Instead of opinion, we write factual findings. So factual findings simply explain. So many creditors didn't match. Simply didn't match. Then so many confirmations were not received. Okay, and so much of payment was made, subsequent payment. We saw the example. And then we need to explain people, warn people that, okay, don't consider it as it is neither an audit, neither a review. We are not going to give any kind of assurance. Okay, any kind of assurance. Very, very important. We warn people about it. Just like in OMP, we write related things, we write here. Okay, that it is not audit, it's not review. Then we say that if we would have performed more procedures as given in the audit or review, we may have come across more additional findings. Okay, so we say people that, see, it's not audit or review. If we would have done audit, review, perform more procedures, we may have come across more findings and would have told more about it. Okay, so don't underestimate our knowledge. Our performance. Okay, if we would have done more, we could have told you more about it. And then this report is for specifically so and so people. It's only for their usage, so it should not be distributed to others. Others should not use it. Even if they use it, okay, we are not responsible for it. And then we clearly specify this report is not okay on the whole financial statement. It's only a very small part of the financial statement, and it may include financial, non-financial item, and then simple signature, date, place, SDP. So guys, this format is very important. First comes title, then come addressee, then comes introductory part when we identify the information and the purpose. Then comes auditor responsibility. We say that we perform agreed upon procedure. We did it as per so and so standard. This is the list. Then we give the factual findings. We tell it's not audit, not review. We then tell people that we'd have got more findings if we'd have performed more audit or review activities, and it should not be distributed to anyone. We are not responsible, and it is not on the whole financial statement, it's only a part of it. Signature date place. We need to put documentation. What we need to document? We need to put enough evidence to explain people that we have performed this assignment as per law, rules, regulations, if applicable, and SRS 4400, and that we have sufficient evidence to support our report on factual finding. For two things: to prove people that the work performed was superb as per law, rules, regulations, and standards, if standards SRS 4400, and last, we have enough documents and evidence to support our report on factual finding. So guys, that was a very simple standard, and it may come for a lot of marks. It may come for a lot of marks, guys. Just a minute. Now, let's go to the next standard, guys. 4410, compilation engagement. Compilation engagement. Very simple. Now, that is 4410, compilation engagement. So, what is compilation engagement, guys? Very simple, straightforward. So, in this particular assignment, we assist. That's very, very important. We assist management in preparation of financial or non-financial information as per applicable financial reporting framework. So when we help people, assist people in preparing information, that's called compilation assignment. And it can be it can be financial, it can be non-financial. That's very important. Non-financial also. Okay. And when you perform this assignment, SQC1 is applicable. Quality control is applicable for all the assurance and related assignments. So it covers all assurance and related assignments, guys. So when you perform audit or review or any assurance engagement or related services, for all these assignment, SQC1 is applicable. Okay. Generally, it is done at the request of the management. Management asks our help and requests us to assist them. Okay. Now, very simple thing. Why the compilation engagement may be required? It's very simple. There can be some mandatory requirement. Compilation generally happens in the practical life that there is one big four which is one firm which is preparing the financial statements, and there is one firm which is doing the audit. Okay. So financial statements can be compiled for a variety of reasons. There can be mandatory reporting requirement. So in companies, there's a mandatory financial statement should be prepared and submitted. Maybe compilation is done for that. Maybe it is done for mandatory as per Cooperative Act for cooperative society, and so on. So it may be done as per requirement of some law that financial statements are prepared for the submission, or it can be for other purpose, for internal use. It can be quarterly financial statements monthly quarterly financial statements are compiled for internal analysis on how good we are doing, how business is doing, are we earning profit, how much assets, liability we have, so on, for internal analysis. It can be for external parties. It can be for external parties. Who wants to give loan to us. It can be for business. It can be for share valuation. It can be for business valuation. It can be for mergers or acquisitions. Okay. Transactional purpose. It can be for share valuation, mergers, and transactions. And definitely, it is not an assurance engagement. It is related services. It is definitely not an assurance engagement. No assurance is provided. No audit opinion or review conclusion is provided. No verification is done in this assignment. We simply assist people in making financial and non-financial information. So guys, we know 4410. We know 4410 what is compilation engagement. Compilation engagement, what do you mean by that? Now we know that compilation can be done for mandatory purposes. It can be done for other purposes, for internal purpose, external purpose, transaction purpose, and it is no way it is an audit review. No kind of opinion is given. We only assist people. Okay. Objectives are pretty clear. So objectives means what? Objective means what targets? Target set for the practitioner is very simple. Okay. Target set is very simple. Whenever you get these assignments, whenever you get this assignment, you should work diligently and assist management in preparing financial, non-financial information. And after, once you prepare that, you should make a report. Yes, guys, you should make a report. Report on compilation. You should make a report on compilation where you simply explain, when you simply explain how this assignment was executed. You don't give any opinion, you don't give any conclusion, nothing, no assurance. So there are two targets: perform this assignment properly, assist management as per the standard, and then make a report on compilation where explain people how this assignment was performed. That's it. So that people don't keep wrong expectations from you. Now, scope here means a range of activities. A range of activities which we perform in the assignment, that's called scope. What we do and how we do it. What we do and how we do it, that's called scope. Scope of compilation assignment. So scope can keep on changing. Management, in some cases, management may ask us that you finalize that as per our information. As per our information, you close the ledger, close books of accounts, make trial balance, and then on this basis, you prepare financial statement, notes to account. Some management may say that just prepare trial balance and other things. Some may say that trial balance is ready, just prepare financial statement. Some may say that even financial statements are ready, draft is ready, just finalize it. Some may say that just prepare notes to accounts. So the scope, that is range of activities we perform, can keep on changing from one assignment to another. Okay, in some, right from finalization of the books till preparation of financial statement be required. In some, drafts may be available. We just need to ensure that everything is covered. Okay, now we want to clearly specify that we are simply assisting, nothing else. We simply, when it comes to scope, okay, we can do it. It keeps on varying. We can do variety of things, but one thing is pretty clear. It is management responsibility to prepare financial statements. It's ultimately their responsibility. They are supposed to decide accounting policy. They are supposed to decide. They are responsible for selecting and implementing accounting policy. They are responsible for making all the important estimates, all the important judgments which are required for preparation of financial statements. They are supposed to do it. Okay. They are supposed to. So they are responsible for accounting policies. They are responsible for estimates and judgments. They are responsible for disclosures. Everything they are responsible. Okay. In fact, it is their responsibility to select appropriate financial reporting framework and implement it. So AED, very famous term, AED, accounting policies, estimates and disclosures. They are responsible for accounting policies selection, implementation, estimates and judgments, disclosures, financial reporting framework, selection and implementation. Okay, our scope can keep on changing. We may do variety of things. We are simply assisting. Management is responsible for every damn thing. Ethical requirements. Now, ethical requirements, yes, when you perform compilation engagement, we are supposed to follow ethical requirement. We are supposed to follow 5 ethical principles. We are supposed to follow 5 ethical principles, guys. Okay, 5 ethical principles, that is must, that is mandatory. No requirement, again very important from exam point of view. Just like in AUP, there is no independence requirement. In AUP, in agreed upon procedure, there is no independence requirement. In compilation also, there is no independence requirement. Okay. And in earlier standard, they say that if you are not independent, give it in the report. Here they have not specified. They say that if law, rules, regulation require, then you should specify may specify requirement disclosure rules pertaining to independence. If the independence issues, law, rules, regulation may require it. That's fine, guys. That's a very small change. So in AUP, you are supposed to disclose if there are independence issues. Here they say that if law, rules, regulations say, disclose it. Not very big thing. Now step number one. Step number one. In the earlier thing, it was terms of engagement were extremely important. Now here it is acceptance. Acceptance. Acceptance and continuance, very important. Here also, the practitioner shall not accept the engagement unless as agreed terms of engagement. So in the earlier also, step number one was there should be terms of engagement, and it should have some very important things. Nature of the assignment, purpose of the assignment, then purpose of the assignment, what procedures need to be performed, and what about the reports. The terms and conditions should be clearly specified. Terms and conditions should be clearly specified. On the same lines here, they say that step number one is that you should accept the assignment only when they are ready to prepare a detailed terms of engagement, and it should clearly specify. Just like, guys, in these standard, a lot of things are similar to our regular standards on auditing. Like we have SA 210 for terms of engagement. The first thing we specified objective and scope. Similarly here, a clear-cut objective should be there. That the objective of the assignment is to compile financial statements, and you are supposed to compile financial statement. Scope should be given. That draft report is ready with the draft financial statement and notes to accounts are ready. You are supposed to finalize. You are supposed to assist management in finalizing it. It's only for one company. So objective and scope should be clearly specified. Okay. Then management responsibility should be clearly specified. It is management responsibility to prepare basic financial information, to maintain books of accounts. It is their responsibility to establish and implement internal control system. They are responsible to ensure the basic information is complete and accurate. They are responsible to make all the judgments. So you simply specify, and they are responsible to select and implement financial reporting framework. You clearly specify management responsibility. You are responsible for preparation of the financial information. Okay, to maintain books of accounts, internal controls for that, to ensure it's complete, accurate. About, see, we have discussed this about the judgments, estimate, disclosure. You are responsible completely. Then practitioner's responsibility. Practitioner's responsibility is to be ethical, and perform this assignment as per SRS 4410. It's pretty simple. Okay, his responsibility is to remain ethical and assist management in preparation of the financial information. Now, do work as per this particular standard, and once work is done, prepare a report on compilation. Then extra, you should specify that it is for only limited set of people. Only this report is only for limited set of people. It is only suitable for them. Hence, it should not be circulated and distributed to others. Others should not use it. Even if they use it, we are not responsible. Clearly specify that. Generally, it is in the form of engagement letter. And if it's a recurring assignment, we don't need to make engagement letter again. We will simply send a reminder letter that our terms of engagement are similar to the previous terms of engagement. That's it. So guys, it's pretty simple. Step number one is again that terms of engagement should be there, and the matter of the terms of engagement is pretty similar to SA 210. The same objective and scope, management responsibility and FRF, then auditor's responsibility, then the practitioner's responsibility and his report, and then we have some extra points. Okay, so very similar to SA 210. Now, this is a very important. How to perform compilation engagement. Extremely important. See, I put a pink star. Wherever I put a pink star, that becomes extremely important. Okay. Now, so if you are appointed to perform compilation engagement, first thing is obtain knowledge of the business, obtain knowledge of the industry, business, what they do, understand the business properly. Then only you will be able to understand the transactions and how accounting, presentation, disclosure should be there. Then you go and understand the financial reporting framework. Okay, if you are have a good understanding of the framework, it can be AS, it can be Ind AS, it can be AIFRS, it can be US GAAP. So first step is the first thing is pretty simple. See, it is written 1A 1B. Okay, just get the understanding. First understand the business entity and its environment, then you understand the framework. Then when you do that, then you get the information from the management. You get trial balance and all related information from the management, and you assist them in compiling financial statements. You put everything in you assist management in putting everything in proper format, in making notes to accounts, including all the information, including all the disclosures. In the process, a lot of judgments. It is management responsibility to make all the judgments and to make all the estimates. You may assist them in making judgments and estimate depending on engagement letter. Sometimes in some assignment they may not read before completion. Very important. You should read the information. Once everything is prepared, read the information. And now comes the most interesting part. Read the information, keeping in mind the business and requirement of financial reporting framework. You may come across incomplete or inaccurate information. While doing all these things, while compiling or reading, you may come across incomplete, inaccurate information being provided by the management. You think that all the branch information is not giving, all the sales are not given, all the purchase are not given. You should go to the management and ask them to rectify the situation. See, we are not performing any examination. We may come across incomplete, inaccurate information. We cannot keep mum. We'll say that please, you rectify it, you complete it, you rectify it. Okay, if they don't do it, withdraw. That's very, very important. They are going to ask you an examination. What is going to be your response if there's an incomplete, inaccurate information? People will write qualify, adverse. Oh my God, this is not audit assignment. This is not audit assignment. This is compilation assignment. This compilation assignment. In this, there's only one thing. If something is wrong and management is not listening to you, withdraw. Because in report, we are not giving any opinion. Only one option, withdraw. Or after reading, you may come across non-compliance with financial reporting framework. There can be material misstatements. Again, we'll go to the management, ask them to make the changes, and if they decline, we again withdraw. Okay, again withdraw. If because of some professional legal responsibility withdrawal is not possible, you should sit and think what else can be done. If you cannot withdraw, maybe you will go and inform authorities about it. Okay, and lastly, you want an acknowledgement from the management. That yes, it is their responsibility to prepare financial statements, and they have prepared financial statement. It's absolutely their responsibility. It's like written representation. So guys, there are 6 points. It's lovely. Point number 1A, 1B is about taking understanding, obtaining understanding. After obtaining understanding, you do the compilation, you assist in judgments, and then read. While doing this, you may come across 2 situations: incomplete, inaccurate information. Ask for the rectification. Don't know it, withdraw. You may come across non-compliance with financial reporting framework. There can be material misstatement. They don't agree, withdraw. And lastly, you take the acknowledgement. That is like a written representation. Okay. In this assignment also, just like in audit, we should be in touch with TCWG. We should have proper communication with management or TCWG. We should keep them informed. After appointment, what are their responsibility? What are our responsibility? When you work, what are significant findings? Everything you should keep them informed on timely basis, especially the significant matters. All the matters, okay, all the important matters with respect to compilation, all the significant matters which are big enough to be communicated to the management TCWG should be communicated on timely basis. So communication is there. And then the most important thing is step number 3. The format of the report. Now, what will the format of the report? Its format of the report is pretty simple, straightforward, guys. It is title. Again, the flow is same, guys. The most important thing if you want to remember things, is the flow. Flow is the most important thing, guys. Flow is the most important thing. Title should be Accountant's Report on Unaudited Financial Statement. Title should be Accountant's Report. Accountant's report on that's very important. Accountant's report on unaudited financial statement. It can be practitioner's report or accountant's report on unaudited financial statement. And then comes the addressee. Whoever's name is given the engagement letter, we'll prepare it for them. It is generally the appointing authority. Then comes the introduction. We clearly specify the nature of the engagement, that it is a compilation engagement, that this report is on compilation engagement. And then we clearly identify the information that we have done the compile. We have assisted management to compile financial statement of so and so company for so and so financial year. Okay. Then comes management responsibility. That it is management responsibility to prepare financial statements, as per applicable financial reporting framework. It is their responsibility to establish internal control systems and ensure information complete and accurate. And then what is the financial reporting framework? So management has selected and applied AS, IFRS or US GAAP, identify the framework. So guys, it's a simple flow. First come title, then come addressee, then come introduction. We have explained the nature of the assignment. We identify the information. We explain management responsibility, what financial reporting framework they have selected and implemented. Then we explain, just like auditor responsibility, practitioner responsibility. Our responsibility was to remain ethical and perform this particular assignment as per SRS 4410. And we like to explain everyone that it is not an assurance assignment. It is not an assurance assignment in any manner. We are not giving assurance. We are not giving assurance. We are not giving audit opinion. We are not giving review conclusion. And then we alert people if required. If it is a special purpose framework, we explain people that the framework used is not a general purpose framework. It's a special purpose framework. This framework can be as per regulatory requirement. It can be as per any contractual requirement or any other requirement. The special purpose framework, this framework is suitable for so and so people. Only they should. It's suitable only for them and not suitable for others. Okay. So we if the framework uses special purpose, we alert everyone about the special purpose framework. Signature date, please. Simple. Okay. Whether engagement level quality control or response is applicable, of course. SQC1 is applicable on all related services. Engagement level, firm level quality control systems are applicable. Now it is responsibility of the engagement partner to implement firm level quality control. So very simple thing you have written. It is engagement partner's responsibility to implement firm level quality control system to the compilation engagement. What are we supposed to document? Initially, we get trial balance. So trial balance and all related information, whatever we obtain, should be documented. Okay. Then reconciliation of how basic books of accounts trial balance they agree with financial statement should be there. So we should document the trial balance and how trial balance and final financial statements they agree to each other, they agree to each other, they match with each other should be there. And then copy of final version of report, copy of final version of the financial statement report should be there, and if any significant matters. So simply what we got initially, then the reconciliation, then the copy of final version and the report and the significant matters. So guys, we are through with chapter number 9. So we took around an hour, guys, to complete chapter number 9. Let's see chapter number 10, and then we are going to see chapter number 11. So chapter number 10, people are frightened with chapter number 10 SRE because of the volume. Guys, we have simplified it a lot. So use that simplified approach. If you use that simplified approach, Great. So Lankesh is very happy. Now, guys, again, there is a case, a situation where the knowledge of this chapter is applicable. We are going to cover two standards in this. So first of all, audit versus review. Okay, if you want to perform audit versus review in audit, if you want to perform audit, essays are applicable. There are 37. Okay, there are 37 standards on auditing, and there are 2 SRE. In audit, we perform a lot of procedures. We perform all different types of examination procedures which we think are appropriate. There are no restrictions, and there we can perform any kind of procedures. Okay, but then in review, majorly we perform only 2 procedures: inquiry and analytical procedures. So audit and review, different set of standards are applicable, different types of procedures are applied. In audit, a lot of time is available, so a lot of procedures are applied. In review, only 2 type of procedures are applied. Once you do that, okay, in audit you get reasonable level of assurance. In review you get limited level of assurance, moderate level of assurance. In audit you give opinion, in review you give conclusion. In audit you use positive wording that financial statements are as per applicable financial reporting framework, they give true and fair view. Okay, we use positive wordings. In review we use negative wordings. That means we have not come across any information which suggests that financial statements are not as per framework, they are not giving true and fair view. So whatever we did, whatever information we have not come across any information which suggests that they are not as per framework, they are not giving true and fair view. So the wording which we use is negative based. There are 2 standards, 2400 and 2410. Okay, if the person who is doing audit of the person who is doing audit of annual financial statements, the same person is appointed to do review of the interim financial statements, monthly and quarterly financial statements. Okay, then 2410 gets applicable. Okay, 2410 will get applicable if the auditor is appointed. If the auditor is appointed, guys, if the auditor is appointed, okay, auditor is appointed to perform the review of interim financial statement, 2410 is applicable. In all other cases, when a chartered accountant practitioner is appointed to simply perform review, any chartered accountant is appointed to perform review, okay, then 2400 will get applicable. So you are appointing an auditor to do review, 2410 will get applicable. You are appointing any other practitioner to do review, 2400 will get applicable. That is the only difference. Both the standards are similar concepts, similar things, almost pretty similar is there. Only when you appoint an auditor to perform review, he can perform audit and review work together. And evidence of audit can be used in review, and evidence of review can be used in audit. That's the only change. That is the only change in 2410. Okay. Let's see, guys. So we know that there is a limited level of assurance, moderate level of assurance. This means that we have collected enough evidence to give the conclusion. Limited level of assurance means risk is reduced to acceptable level. Very interesting, guys. Reasonable means risk is reduced to low level. But limited assurance means risk is reduced to acceptable level. Acceptable level, it gives lower level of assurance as compared to reasonable level of assurance. And the word we use, we don't use the word opinion, we use the word conclusion. We express after doing review, we don't give audit opinion, we give review conclusion. So there are the standard which are applicable are SRE. There are 2 standard, 2400, 2410. We have discussed. If you appoint auditor to do the review of interim financial statement, monthly, quarterly, 2410. And if you appoint any chartered accountant to do review, that is 2400. So depending on who is doing the review, standard will change. If auditor is doing it 2410, someone else is doing it 2400. It is it for all assurance and related assignment, SQC is applicable. So SQC is applicable into this particular assignment also. Okay. This turn is going to simply explain how to perform the review engagement, how to make report. That's it. It is a mere repetition of what we have discussed. And review can be of general purpose framework or special purpose framework. That's very interesting. So, like just like audit can be for general purpose financial statements and special purpose financial statement, the same lines. A review of financial statement can be done if it is general purpose or special purpose, irrespective of that. And the most important thing we do is inquiry and analytical procedures. That is the most important thing, and we are going to discuss in detail later that if we feel that there is a potential material misstatement, then we increase our examination procedures. Yes, we do that. We are going to discuss about that. We definitely perform additional procedures. We can increase the level of analytical, we can increase the level of inquiry, level of analytical procedures, and we can perform other procedures as well if there's a potential material misstatement. So this was targeted in the MCQs. Yes, the principal method is inquiry analytical procedure, but if we require, we can take one step ahead. We can go one step ahead, guys. Now, what are the objectives? Objectives means target. Target are pretty simple, guys. You don't need to mug up. Target is pretty simple, that you perform this assignment, to perform the review assignment as per respective standards on review engagement, SRE 2400. Okay. And you perform inquiry analytical procedure. You get sufficient appropriate evidence so that with limited assurance you can give conclusion, frame the conclusion, then you make a proper report, review report. If required, you can modify. If required, you should, if there is no sufficient appropriate evidence or there are material misstatement, you can modify the conclusion, and in some circumstances you can withdraw. So what is the objective? Target is pretty simple. See how I have said it step by step. Objective is pretty simple. Perform the assignment as per the standard, perform analytical review procedures. It's absolutely fine to write few more things. Get reasonable, get limited assurance, moderate level of assurance, go for the conclusion, frame it, make report, if required, give modification, withdrawal. Now, are we supposed to be ethical? Yes. When you go for review engagement, you are supposed to be ethical. You need to fulfill ethical requirements. You are supposed to fulfill ethical. You are supposed to fulfill ethical requirement. We are supposed to be independent as well. We should be. Now, this is very important. 4400 and 4410, there was no independence requirement. But once you come to review, there is an independence requirement. An engagement partner needs to ensure that the team is ethical and independent. It's pretty simple. Okay. Now, guys, from here on, I'm saying, from here on, a lot of concepts are going to come. No need to learn them. No need to learn them unless something is important. They are simply copy pasting and repeating the concepts of standards on auditing. See, when it comes to review, only SRE is applicable. There is no separate SRE for engagement letter. So they are putting things of 210 here only. Yes, they are putting 210 here only. There is nothing, there is no separate standard for documentation. So they are putting documentation principles here only. There is no separate standard for communication with TCWG. So they are putting it here only. In audit, for different things, we have different standards. In review, we only have two review standards. They are not separate. So they have put all the concepts in one standard, and they are copy paste just like audit. So even if you don't learn single word from here, simply express whatever you know from standards on auditing, keeping in mind the review thing. Just use the word review instead of audit. That is more than sufficient. So acceptance, just like we have acceptance and continuance procedure as per SA 220, here also they say that you should be careful for acceptance and continuance of review engagement. Okay, same lines. So you should see same lines. Limitation on scope. We study this into a limitation of scope. If you should see whether management is putting restrictions on the range of activities we perform, whether there is a limitation of scope. And if the limitation of scope is so much, limitation of scope is so much that in future you will have to disclaim the conclusion, you should not accept such assignments. Same thing, copy paste is given in SA 210, limitation on scope prior to acceptance. Same thing they are discussing. Okay, then before accepting, you should think carefully whether whether they will be able to fulfill the ethical requirement, and the team will be able to fulfill ethical requirement and independent. Okay. Then this is something extra. Rational purpose. You should think carefully why they are. What is the purpose of this whole assignment? What is there a rational purpose for the whole assignment? For example, if it's a listed entity and they have to submit quarterly financial statements, and there's no enough time to do audit. That's why they are getting review done. Then you understand, okay, there's a rational purpose. Suppose audit is going to take a lot of time. It's only 6 months. Audit is going to take a lot of time. It's an annual audit, and they want some report to be presented in the front of banks and other financiers. That's why they are asking. There's a rational purpose. If there's a rational purpose, it is absolutely a rational purpose. That's great. But sometimes there will be irrational things, and you may not accept the assignment. You know that they have an auditor. Audit will be completed within 15-20 days. They will have an audit report. Why they want review report? Something is fishy. Something is extremely fishy. Why, if they have a high quality audit report available, why they want a review report? Whether they want to hide things in review and get positive review report? Is there something like that? So you should go and see whether there are irrational purposes. Okay. So some irrational things are there. For example, law, rules, regulation require that these financial statements should be audited. When law says the audit should be done, but they are getting review done. Are they trying to fool people? By giving review report instead of audit? That's an irrational thing. Or they are getting audit done from a very small firm. They are getting review done from a very big firm, Big Four firm. Whether they just want to use the name of the firm, they want to associate the name of the firm, where they want to boast everyone that a very big firm has done our review. Is that the intention? They want to use the misuse? Something wrong. Don't accept the assignment. It's irrational. Law says audit. Why are you getting review done? Don't accept the assignment. They suspect the association misuse of the practitioner's name. Don't accept it. They're putting a lot of limitations, significant limitations, that they are not giving freedom of doing review. That's quite irrational. Don't accept. You may get a question in exam. In this situation, don't accept the assignment. If you think that review is not proper, okay, when the practitioner preliminary understanding of the engagement indicates that accepting review would not be appropriate, then you should say that, listen, as per your expectation, what you want, review is not suitable for you. You should go for the audit. We'll do audit for you. or we will do compilation assignment for you, but we don't think review assignment is suitable in the circumstances as per your expectation. So we may suggest audit or compilation. Doubt on management integrity. If you doubt the management integrity, you may not accept. If you feel that the availability of the information, they are not ready with anything, how can we do review in 1 week's time? They are going to take 15 days to finalize the books of accounts. So there's a shortcut also that if people come to you for review, read information. First read information. Say, okay, there's a limitation of scope. We'll have to give disclaimer. You think, don't accept it. You're not able to fulfill ethical requirement, independence, don't accept it. There should be rational purpose. If there are irrational things, they are going against, they are not following law, rules, regulation, they are being suspicious, they want to misuse our name, law restriction, don't accept. If it's not good, suggest them, go for audit or compilation assignment. There's a doubt over integrity, don't accept. You think that the available information is not there, don't accept. Okay, so there's a shortcut also. Now, guys, copy paste, preconditions. Just like in audit, we have precondition as per 210, same to same preconditions. There are two preconditions. First, management should go in writing that preparing financial statement is their responsibility as per applicable financial reporting framework. For that, they will establish internal control system. Okay, then they will share all the information with us. They will make more information when we ask for it. They will give access for inquiry. Same. And the financial reporting framework should be acceptable. Copy paste same. Okay, if practitioner is not satisfied that primary conditions are fulfilled, go to the management that listen, we want agreement and the framework should be acceptable. If management is not ready to listen, okay, don't accept the assignment. But if there is legal requirement that you will have to do it, fine, do the assignment. Don't give reference of standards. Don't say that this assignment is performed as per standards on review engagement. Don't give any kind of reference. Okay. If after accepting there are issues and problems on this line, on same lines, okay, ask for resolution. If after acceptance these problems arise, there's a problem with they're not following the agreement, the framework is not proper, ask them to resolve it. If they're not ready to resolve, okay, then we have the option, either we'll have to modify the report depending on the situation. In initial stages, we may think about withdrawal. In later stages, we may think about the modifier. So it's very simple, guys. So just like we have preconditions of audit, we have preconditions of review. Copy, paste as it is, same as 210. Okay. So a lot of concepts will be here. Now, guys, I said further, guys, students who are from the south and they're very comfortable with English, you see my English lectures. Okay, and those who are comfortable with English, we have already recorded everything. All the important concepts we have recorded. All the important concepts we have recorded. All the important questions we have recorded. Top 100 MCQs we have recorded. Top 100 MCQs also we have recorded. You go to Ravi Taori channel, you go to the playlist, you'll get Hindi playlist as well as English playlist. You'll get both the playlist. You'll get playlist for concept revision. You will get playlist for concept revision. You will get playlist for important questions. You'll get the playlist for the MCQ also. Okay, so you can use that. Then agreeing the terms, copy paste same. Just like audit in review engagement, there should be terms of engagement. There should be Initially, you agree for the terms of engagement. If there's a recurring engagement, no need to make a new engagement letter every time. Simply exchange a letter which specify that the old engagement letter will be applicable. Yes, you should make a revised engagement letter if it is required by the circumstances, if required. If there is a change in terms, after once you start the engagement, if there's a change in term, you should see is it reasonably justified. If justified, go for the changed engagement letter. If not, think about the withdrawal. Think about withdrawal or modification as suitable. Okay. So sometimes people will come and say that we don't want review. Uh, go from review to AUP agreed upon procedure. We may do it. We if it is justified, we may do it that also. All these principles are copy paste like 210. Having terms of engagement in every assignment, recurring assignment, no need to make it. If afterward there's a change in terms, it should be justified. And if you want to change the assurance, absolutely fine. If justified, you can go for that. No problem. Then, how to perform the review? How to perform the review? Guys, take a 5-minute break. Okay, guys, now how to perform review? How to perform review now? A very simple answer is that you simply perform analytical procedures. Inquiry analytical procedure is done, but then they have specified, they have given in further detail how to do that. Okay, they love making standards. They love making more and more standards, more and more theory. Okay, guys, now listen to this once. Listen to this once. It may be useful. And as I said, simply apply the concepts of standards on auditing. In one line, I'm saying simply apply the concepts of standards on auditing. That is more than sufficient. Okay, let's see, guys. Mudda technique. M stand for mudda. Mudda means topic, the matter, the issue. Mudda. Mudda technique. So that is materiality. So just like in audit, you have to compute materiality level. On the same lines, in review also, you have to compute materiality level. Okay. So very important from the exam point of view. Irrespective of level of assurance, materiality is computed in same manner. Materiality should be computed. It is computed in the same manner with same principles. You know, to do that, irrespective of the level of assurance, materiality level remains same. Very important from the MCQ point of view, from the case study point of view. And once you decide that, afterwards, if you get more information, more relevant information, you can revise it. You can revise materiality level. Then that is M. M stand for materiality. U stand for understanding. Of course, here also we need to understand entity and its environment, including internal control systems. We need to understand the industry. We need to understand the industry, the entity, okay, entity's governance, entity's business, internal controls. We need to understand the financial reporting framework so that we can find out where are the complexities, where are the complexities, where are the judgment issues. Okay, wherever there are complexities, wherever there are judgment issues, okay, pressure issues, these are the areas of likely misstatement. They don't use the word risk of material misstatement. They use the word likely. Okay, likely, wherever they are likely material misstatements. Material misstatements are likely. Even if you use the word risk of material misstatement, it will be absolutely fine. Don't be finicky, guys. You need to give the concept. Okay. Then D stand for designing. So once you do this thing, decide the materiality level, you obtain all the kind of understanding, get the areas where the material misstatements are likely, mark them. Then you decide about you decide what kind of inquiry and what kind of analytical procedure to perform. Then you think about inquiry analytical procedures, and you may go for the other other procedures all as well. Depending on the circumstances, how likely that things may go wrong, then you can go for the other procedures also. Inquiry analytical procedures are the major procedures, are the most important procedures, predominant procedures, but then you can go for the other procedures also. Okay. And when we talk about, so we may go and read the contracts. We may go and read all the important revenue contracts, expense contracts, transaction contracts. We may go and read all the contracts. We may go and see the underlying accounting records, review the accounting records. Okay, is there anything unusual? We can go for ledger scrutiny. We can do that. We can read important contracts. We can go and review important accounting records. And even when we do it, objective remains same, limited assurance only. Okay, so when we design procedures, we are predominantly and then inquiry analytical procedure, we can go for other procedures as well. Just ensure all material items are covered. Yes, for all material items, something or the other should be performed, either inquiry or analytical procedure or any other procedures. Then all the areas where material misstatement are likely should be covered, and we should achieve the objective of SRE. We are supposed to collect sufficient appropriate evidence for giving limited level of assurance. So ensure that we are achieving that. So when we design, if we focus on one thing, we can go for we focus on things, we can go for other procedures. Okay, and just ensure all material items are covered, all areas where misstatement is there, it should be covered, objectives are achieved. Very simple. Inquiry. So this can be asked. Inquiry. So what things you focus on in inquiry, what inquiry you do, what things you focus on, what things you cover in your inquiry. Fun at Madras and NCR. NCR is National Capital Region. You must be aware. Delhi, National Capital Region, NCR. So this can be asked as a question that in inquiry, what inquiry you do. So F stand for fun at Madras. F stand for you do inquiry about fraud. Then U stand for you do inquiry for significant, unusual and significant transactions. You can do inquiry about the frauds, whether there are suspected frauds during the year, actual frauds, detected frauds, about the unusual transactions, significant transaction. You can do inquiry for non-monetary. If there is a non-monetary transaction, barter which has taken place, well, how many non-monetary transactions, what are the big amounts, what kind of barter, who decided the value, how it was executed, and so on. You can do inquiry about that. For at Madras, matters arising from other procedures. So after analytical procedures, you may come across a lot of inconsistencies, a lot of fluctuations. You can do inquiries for that. We can do inquiry for accounting estimate. You can do inquiry if there's a doubt over going concern. If there's a doubt over going concern, inquiry about related parties, then inquiry about actions at meetings. So if the shareholders meetings, board of directors meetings are there, what they have decided, what action they have decided, what should be done, do inquiry about that, how they're implemented. Do inquiry about the subsequent events after year end till the date financial statements are finalized. Do inquiry about whether management has made assessment about going concern, assessment of going concern. Do inquiry about that. You can ask for non-financial. Yes, you can ask for non-financial data also. No one can stop you from doing that. Then if the company has commitments or obligations, they have signed the agreement where they have purchase commitment, for finance commitments, an obligation. Do inquiry about that. About the regulatory communication. Okay, communication the entity has had or anticipates. What communication they are having with the regulatory authorities? What kind of communication responses are there? So you do inquiry. Fun at Madras and NCR. You do inquiry of fraud, unusual transactions, non-monetary transaction. Madras, M for matters arising from other procedures, A for accounting estimate, D for doubt or going concern, related parties, actions at meetings, subsequent events, assessment of going concern, non-financial data, commitments and obligation, regulatory communication. When it comes to analytical procedures, in analytical procedures, broadly, we compare things. We compute expected amounts and ratios, and we compare them with actuals. And if there's a fluctuation, we go and investigate it. That is analytical procedures. So a lot of data will going to come from accounting system. Okay. A lot of data is going to come from accounting system, and we focus majorly on inquiry. Now there was a question. Why we use inquiry, and that's why it's marked important. Why we use inquiry and review a lot? Why we use that? Okay, because they are one of the best techniques. Inquiry is one of the, why we use inquiry and analytical procedures a lot. Okay, because they are the best technique. Inquiry is one of the best technique to know about the management intention. Our accounting is influenced a lot. Our accounting is influenced by a lot because of management intention. Okay, depending on intention, asset can be fixed asset, it can be investment, or it can be inventory. So management intention, the best way to understand management intention is inquiry. So we do a lot of inquiry, we get information from the inquiry. Whatever response we get, we corroborate it with past data, present reasons, and future abilities. Guys. So, and we should be very alert when we evaluate the responses. So it is very good for management intention. Why we use inquiry a lot? Because it's very good to understand management intention, to understand the responses, corroborate it, evaluate it, and very good for understanding entity and environment. Okay, that's why we use inquiry a lot. Okay, then why we use analytical procedures a lot? They are excellent. They assist us. They're excellent. They assist us. They assist in what? Okay, they assist in identifying potential material misstatements. Okay, they assist us in potential material misstatements. So there's a shortcut, potential ICU matters. Okay, potential ICU patients. So they help us a lot for identifying what are the potential material misstatements. They help us in identifying inconsistencies, fluctuations, differences, and they can give very good evidence to corroborate some other evidence. They are very good for identifying potential misstatement. They are very good at identifying inconsistencies and fluctuations. They are very good in getting corroborative. When one evidence is confirms other evidence, called corroborative evidence, and they are very good in understanding again entity and its environment. So these guys are extremely good in identifying potential ICU matters, big matters, potential ICU matters, big matters. That's why these are preferred a lot. When you compare with previous year, you understand new development and changes in the organization. Compare with when you compare with others, you understand strengths and weakness of the organization. We can have different methods of analytical procedures. We can use financial, non-financial data. We can compare with the previous year, that's a trend analysis. Compare with the budget, that is comparative analysis. Compare with your own estimate, that is predictive analysis. Others, that is interform analysis. A lot of things can be done. So this can be, this has been the question. They're excellent, inquiries excellent for management intention and understanding entity and environment. Analytical procedure is superb for potential ICU things. Now, Mudda. So we were discussing Mudda technique. The A is address specific circumstances. So they have made a list that, okay, you are using method, inquiry, analytical procedures, but in some areas, okay, some areas pay special attention. So pay special attention when related parties are using fog. Oh my God, what a fog. Okay. So special attention, thing address related parties. Go and go and be careful where there are whether there are related parties. You have come across related parties which were earlier unidentified, undisclosed related parties. Are you coming across related party relationships or transactions which is outside normal course of business? Do inquiry about it. Understand the business rationale. So they're saying focus more on related parties, whether new related previously unidentified, undisclosed related parties are there, or significant transaction outside normal course of business is there. Then fog. Pay special attention to the frauds. Talk about whether there are indications. Look for it, whether there are indications of fraud, which indicate fraud has happened. Okay. What is management's assessment of suspected or detected actual frauds? Then if you come across fraud, then are you supposed to report it? Are you supposed to report it anywhere? Report it to the external parties. Understand your responsibilities. So look for the indications, look for the frauds. Then you think about it. Like in Caro, but Caro is applicable to audits, not here, where you have to report those frauds, external parties also. Going concern. So fog. Last is G. Okay. We have O also, work of others, and then G. Here also same 3 steps of SA 570. Look for events and conditions which is significant out or going concern. If there are, look for the future plans. Look for the future plans to counter the negative issues and matters. Okay. Evaluate, do inquiry about the plans. Evaluate their responses. Assess their responses, whether they'll be able to protect going concern. Where there's something wrong, there is a material misstatement or misleading representation about going concern. So look for events and conditions which create doubt. If there are, go for inquiry. Future plans, whether the future plans are good, look for them. Others, yes. You may need help of other practitioners or experts. There can be there can be internal auditors, there can be branch auditors. Okay. You in review, you may use the work of other professionals as well. Always ensure that their work is sufficient. Okay. While in group financial statements, you have to deal with subsidiary auditors, joint venture auditors, associate auditors. Fine. So guys, that was addressing space special into specific issues, related parties, frauds, other auditors and practitioners. and going concern. Mudda, A stand for very, very important, very, 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 very important, additional procedures. So what they say that if you come across a situation where there is a possible material misstatement, if there's a possible material misstatement, potential material misstatement, you feel that material misstatement can happen, can be present here, okay, we should not hesitate. We should go for additional procedures. You should perform additional examination procedure for sure. Okay, purpose is pretty simple to find out. Purpose is pretty simple whether to find out whether the financial item is free from material misstatement or whether there is a material mistake, whether there is a materially misstatement. Either we want to be sure that there are no material misstatement, or we want to be sure there is a material misstatement. Okay, so we perform additional procedures so that we get absolute clarity. We reach any of these two conclusions: there are no material misstatement or there is a material misstatement. Okay, and types of procedures, we may go for additional inquiry analytical procedure. We can increase the level of inquiry analytical procedures, or we can go for any other type of substantive test of details, external confirmation, anything we want. We can go for it. And they are giving examples. So there is a overdue. You came across overdue account receivable. So there is a long outstanding debtor, and they have not made any provision for doubtful debt. They are not written it off. Okay, you go and make specific inquiry for the uncollectible accounts. Do more inquiry about it. And after management response, you may come that there is no, you analyze their responses, how reliable, what they're saying. You may come across no material misstatement. You may come across that there is a material misstatement. You may come across that evidence is lacking. We need to perform more procedures. We can go for additional audit procedures, more evidences, and then draw the conclusion. Continue the additional audit procedure till the time you reach the conclusion. Either they are free from material misstatement or there are material misstatement. If someone stops you, you will have to report. We will have to take the impact on the report. So yes, if there is a potential material misstatement, we perform additional procedures. We have to reach the conclusion, and it can be the purpose in PPT. P for purpose simple, either to reach one conclusion or the other. Type of procedures we need to perform, we have seen. If there is a potential material misstatement, then we perform more procedures. Purpose simple, and these are the type of procedures we perform. This is an example. Guys, again, copy paste same standard. Subsequent events. So for all subsequent events which are happening after balance sheet date, till the time we make the review, till the time we make review report, okay, you should do inquiry about them. You should do inquiry about the subsequent events. If there is an adjusting event, it should be, if there is an adjusting event, ensure it is properly adjusted. After the review report is given, there is no obligation at all. But if you come to know information which would have changed your conclusion, then just like 560, go and discuss the matter. What is this matter? How is this matter? If you come across that inventory of 100 crores was obsolete, go and discuss this matter. Is this real? Okay. If it is real, then next, whether the amendment is required in financial statement. If yes, what is their intention? So this same copy paste 560, guys. If management is not ready to make amendment, we'll have to take, we'll ask management, see, it's required suitable action. We can give public notice, or we can go and speak at AGM. Written representation. Written representation, guys. So just like you have written representation audit, on the same lines, there's a written representation in a review also. Very important source of information, very, very important source of information, very important evidence. It gives very big protection. We have to take written representation about management responsibility. Give it to us in writing. It was your responsibility to prepare financial statement as per applicable financial reporting framework. Okay, and then ensure, then you only that you have included all the transactions, all the transactions are covered, nothing is left out, and it's properly accounted for. You give responsibility that you have prepared financial statement as per applicable financial reporting framework. You have ensured everything is covered, everything is properly accounted for. On the same line, if there are public statements available which cover everything, no need to take those statements again in writing. Apart from that, other written representation if required in any area, you want more support, more assurance, then you can definitely go and ask for more things in written representation. So this can be asked now. So what kind of things we ask? So Frank's NGO, we ask good things about Frank's NGO. We ask them to write that they have shared everything about frauds and suspected frauds. They have shared everything about related parties, non-compliance of law, rules and regulation, commitments, obligations and contingencies, about subsequent events adjusting or everything requiring adjusting or disclosure. Frank's NGO, about non-monetary transaction, they have disclosed everything. About going concern, they have disclosed everything. So in review also we go for written representation, guys. It's pretty simple, straightforward. Two types of written representation, and these are some things we definitely ask for it. We ask for frauds, related parties, non-compliances, commitments, subsequent events. Okay, listen to this once. You may remember, it may be targeted somewhere in the MCQ. If it is not provided, that's bad. Same like SA 580. We'll go and discuss and try to explain them. If we don't understand, we'll reevaluate. Are these guys really having integrity? Are we supposed to believe them? They're not giving such an important document. Okay, reevaluate, take appropriate action. It can be anything. Okay, it can be anything. It can be, it's in early stages, it can be withdrawal, later stage, it can be disclaimer. If shall withdraw or give disclaimer if there is issue with the integrity of the management. In the process, you doubt the integrity. If they don't want to take responsibility of financial statements, such an important thing, you may think about, it's early stages, you may think about withdrawal or you may think about giving disclaimer. Now, so guys, I understand it is long enough, it is big enough, it is very long, it is very big. I understand, guys, but then just listen to it once. Okay, let's see. Now, so we have discussed how to obtain, how to perform the review. What if there is a potential misstatement? That's was very important. So you perform a lot of things, you get a lot of evidence. So guys, I understand it's a long, but then simply keep listening to what I'm saying. 2400 we are discussing. We know there are two types of standards. We know how review is different. We know objectives are pretty simple, straightforward. They want us to do few things. Then how to perform review, what things to focus on. Then after doing a lot of these things, we are going to get evidence. So they are giving basic principle and then explanation. Basic principle and then explanation. Okay. So basic principle is pretty simple. Evaluate. So once you get the evidence, simply sit and evaluate whether it's giving sufficient appropriate evidence about all the important financial material items. Are you getting sufficient appropriate? So are you supposed to get sufficient appropriate audit evidence in review also? Yes. Just like in audit. In audit, we get sufficient appropriate evidence for reasonable assurance. Yeah. Here we get sufficient appropriate evidence for limited assurance, for conclusion. So sit and whether sufficient appropriate evidence about all material items, income, expense, liability, disclosure is there. If not, you need to perform other audit procedure. Exactly. So first they explain the basic principle, then the further explanation. That is how our standards are drafted. First they give the basic principle and then in the explanatory thing, they explain more. They're explaining that thing again. If they have obtained sufficient appropriate evidence, that is great. If it is not sufficient appropriate evidence, then the practitioner may extend the work extend the work, whatever they did it in more volume, cover more items, okay, or perform other procedures. So if the evidence is not sufficient appropriate, you can simply perform something which you have done, but you increase the sample size, or you can perform other procedures as well. If there is inability to get sufficient appropriate evidence which was required, then we have to take the effect on report. We have to qualify the conclusion or give disclaimer. We take the effect on report. Very simple. Sit and see whether we have got sufficient appropriate evidence. If not, you perform more procedures, extend or perform more procedures. If that is not helping you, take the effect on report. What if there is a limitation on scope? If management or TCWG, they restrict the range of activities you are performing, if there is a limitation on scope, okay, be careful. Just inability, only because there's the earthquake or tsunami, you're not able to collect, that's not called limitation on scope. When someone stops you from performing, that's limitation on scope. Management imposed limitation, okay. So if there's a limitation of scope, you go to management TCWG, ask them to remove it. And even if it is not removed, then we'll have to take the impact on the report, review report, and also think about engagement continuance, withdrawal. Copy paste same, guys. So once you get evidence, if it's not sufficient appropriate, extend, perform more procedures, not take the effect. On the same line, there's a limitation of scope, they're not rectifying it, take the effect. Forming opinion, copy paste 705. Okay. When you're forming conclusion, see what are the uncorrected misstatements, see quality of financial statements, see whether there is a fair presentation framework where overall view is appropriate, underlying material transactions and events are properly accounted for. See, so when you're framing the conclusion, see how many uncorrected misstatements are there. What is the quality of financial statements? For true and fair view, what is the overall view which you are getting from financial statements? Whether material events and transactions are disclosed properly. And then after seeing all this, appropriate, it can be modified or unmodified opinion. If everything is all fine, we have obtained sufficient appropriate evidence for the moderate level of assurance, limited assurance, and financial statements are as per applicable financial reporting framework, then we give unmodified conclusion. And unmodified conclusion, we have not obtained anything, nothing has come to our attention which causes us to believe that financial statements are not as per applicable financial reporting framework, or it doesn't give true and fair view. For compliance framework, nothing has come to attention. We say that the financial statements are not as per applicable financial reporting framework. Simple. Modified conclusion, there can be two reasons. Copy paste 705, guys. Even if you don't remember a single word, simply write 705. If there are material misstatements, we may modify the opinion. If there is no sufficient appropriate evidence, inability to obtain sufficient appropriate evidence, we may go for, or there is a material misstatement, we may go for modifying the conclusion. Impact on the report. Impact on the report is pretty simple. We have to include basis of conclusion. We have to include basis of conclusion section. Okay. So just below conclusion section, now see, in the old formats, basis paragraph was included only when there is a modification. So there will be a heading, qualified conclusion, adverse conclusion, disclaimer of conclusion. In the base paragraph, you are supposed to explain the reason, the matter which is giving rights to modification. Immediately before, now that's very interesting, in the old report, basis paragraph used to be given first and then the conclusion in the old report, the old way of reporting. So as I said, there were two principal changes. First, opinion section come afterwards. Second, opinion comes afterwards, after audit responsibility. Then the basis paragraph is introduced only when there is modification, and it is before the conclusion paragraph. If there is a material misstatement, we may go for if it is material but not pervasive, qualification, material and pervasive adverse. What kind of wordings? Except for the effect of the matters which are explained in the basis of qualified opinion, qualified conclusion, nothing has come to our attention which suggests that financial statement not as per framework, they are not giving true and fair. Very simple. In compliance framework, except for the effect of the matters, nothing has come to our attention whereas we say that financial statement not as per applicable financial reporting framework. Adverse, if material and pervasive are there, we go for adverse conclusion. Here, because of significance of the matter described in basis for adverse conclusion, financial statement are not as per applicable framework, they don't give true and fair view. In compliance, simply not as per framework. In basis, if there can be two issues, okay. If there is an inability to obtain sufficient appropriate audit evidence, explain the reason why it's happened. If there's a problem, there's a material misstatement, specify the amount. If not, then you explain not able to specify the amount. If narrative disclosure is wrong, explain what is wrong with it. Omission is omitted, see carefully what information is there. If it's not confidential, not against law, no issues, you can disclose that. Narrative disclosure are extremely important. So if there are issues with the amount or their disclosures or omissions, narrative disclosure, it should be explained. If there's an inability to sufficient, see everything they are covering covers appropriate audit evidence. If it is material not pervasive, qualified, material and pervasive, disclaimer. At least with me, you can going through this once. Withdrawal. If there is limitation of scope, we are unable to obtain sufficient appropriate audit evidence. It's a material and pervasive thing. Okay, it's happening in the early stages. We may think about withdrawal. If it's happening on the later stages, we may think about disclaimer. If withdrawal is not possible, we go for disclaimer. Same copy paste in 705. If unable to obtain evidence because of possible effect due to matters which are explained in the basis of conclusion, we say because of conclusion, possible effect of the matter which are explained based of qualified conclusion, nothing has come to our attention which suggests that financial statements are not as per applicable framework or not giving true and fair view. So we use the word possible effect when there is lack of evidence. Disclaimer, because of the significance of the matter explained, unable to obtain sufficient appropriate evidence, we are not expressing any opinion or we are not expressing any conclusion, and give the reasons why so. Finally, guys, the report. Finally, the report. We explain the title. We explain title. Below title, we have addressee. So there is a title, there is an addressee, there is an introductory paragraph. We say that we have performed review. You name the company, financial statement items, which year, introduction. There is a management responsibility. There is a practitioner's responsibility. Then we explain people that what is review. We majorly perform only inquiry analytical procedures. We explain that the procedures we perform are substantially less than audit. So the assurance level is low. It's not reasonable. It's limited level of assurance. Find the conclusion wordings will be there. If there is a modified conclusion, paragraph is included basis of conclusion before the conclusion paragraph. Then also that we were ethical. In practitioner responsibility that we were ethical, and then signature date place. So title, then addressee, then the introduction, management responsibility, practitioner responsibility, he was ethical, how he performed the assignment. And then in what we do in review, how it is less than the audit. Let's not have wrong expectation, finally the conclusion, modified conclusion, date. Very simple. Emphasize of matter paragraph. Emphasize of matter paragraph and other matter paragraph. So just like in audit, we put EMP, OMP. If we want to highlight something in financial statement, we put EMP. If you want to highlight something in which is outside financial statement, we put OMP. There's one interesting concept. There's only one interesting concept. Old, which is there in the SRE also. When we put EMP and OMP, we say that report modified, conclusion unmodified. Getting it? They used to say that if you put EMP, OMP, so they had this concept, report modified and conclusion modified or not. When you put EMP, OMP, they say that report is modified. This is not how we use the wordings today. Today it's pretty simple. Only when you put qualification adverse disclaimer, that's a modification, nothing else. So previously they used to say EMP, OMP means report modified, but conclusion unmodified. So they had this report modification and conclusion modification, two different concepts. In today's time, we have removed the concept of report modification. This simple opinion modification is there. Other responsibilities. So law, rules, regulations are applicable. Put a separate section and write things as well if they're applicable. Reporting on other legal and regulatory requirements. Documentation. Why this assignment is there, what things we have done in assignments, that means procedures what were performed, results, what results we have obtained, significant matters, judgment, and the conclusions. So we are supposed to document the nature of the assignment, why it was performed, what parts, what procedures were performed, what results were obtained, what significant matters and judgments, conclusions. Every damn thing we study this in 230. Document NTE, who performed the procedure and when, who reviewed and when, what discussions were happened. If there is an inconsistency in inquiry, the discussions. When it comes to inquiry, the discussions, what discussions have happened. Inconsistencies, if there's significant matter, all those things need to be documented. Documentation. Audit versus review, we have already seen. We have already seen audit versus review. So guys, that was a mammoth, but then majority things were as per standards on auditing. Majority things were as per standards on auditing. So that is the one point, and some things were extremely important. Okay. Now, 2410 guys, let's see. Now, this is very similar, very similar to what we see in 2400. Okay. Let's see guys. So when is 2410 applicable? First is very simple. It is pretty simple. When is 2410 applicable? Okay. Let's understand this guys. If auditor is appointed to review interim financial statements, 2410 will get applicable. Okay. Generally auditor will never be appointed to review annual financial statement. Why so? When audit is already going on, so common sense, that situation will not arise. So whenever auditor is appointed, that you only do the review, 2410 is applicable. Interim financial statements, when financial statements are prepared for a period less than a year, that's called interim financial statements. It can be monthly, it can be quarterly, it can be 6 monthly. Objective is pretty simple. The target set is pretty simple, that you perform review engagement as per the standard, you get enough sufficient appropriate evidence for the moderate level of assurance, limited assurance, then you make the conclusion, then you make the report. That is your objective. Then you make the report, then you make a beautiful report as per the standard, and as required you may modify or withdraw. We have seen it. So objective means what are you supposed to do? What is your target? Your target is this only. Perform review engagement, get review procedures done, get good level of evidence. Okay, that is the objective. Frame reports and give it to you. Definitely it is different from audit. So we have seen the differences. Here also copy paste same, guys. SA 210. Okay, we have to agree to terms of engagement. We have to include a lot of important details, objective, scope, management responsibility, FRF, auditor responsibility, format of the report, and so on. Then we have to understand entity and its environment, including internal control systems. Entity and environment, including internal control systems, everything properly. Financial reporting framework, so that we can find the complicated areas, judgment areas, pressure areas. We can find out the areas where material misstatements are likely, potential material misstatements are there. So get all the understanding done. Even the auditor's previous understanding, of course. If the auditor has audited the entity's financial statement for one or more annual, we can definitely use previous year audit document. That's the most important thing. In review, you can use audit documents. In audit documents, you can use review documents. You can definitely use, if you perform audit before, you can get previous audit documents, previous review documents. You can always obtain them. And you should update the understanding. Now, this is very interesting. This has been asked as a question. This has been asked as a question in test your knowledge, test your understanding. And important question, updating understanding. So what they're saying, that auditor keeps doing audit a lot, and then he on quarterly basis, monthly basis, he does review. How he should update understanding. So there's a very simple thing. If an auditor is coming to review, the first thing is he should catch hold of all the past records and documents, past records. He should if auditor is coming to review, he is supposed to brush up his information, his knowledge, and for that he should see all the past documentation. He must be having record of past reports, past audit reports, past interim review reports, past financial statements, past interim financial statements. Okay, he must be having documents of significant risk of the past. He should go and read them and brush up the understanding, overall understanding. He should see what is the current status, what things have changed. Then he should see current significant financial matters, current financial statements, financial data, latest annual financial data, latest interim financial data. So go and see the past, see what has changed, go and see the current thing. That can be good source of information, of obtaining understanding, and you should understand what things have changed. So that will be very useful to understand the changes. Okay. Then current year information. Results of internal audit. Go and read internal audit report, can be good source of information, what changes have taken, that changes place. Internal audit report. Then whatever audit procedure performed during the year, what are the results? That can be good source of information for updating knowledge. Then go and understand all the material items in interim financial statement. That will again update your knowledge. So see, it's beautifully. First we spoke about a lot of past data. We should read it, update it. Okay, upgrade your information understanding, what changes have happened from current year internal audit, current year audit procedure, current year material interim financial information. Do inquiries about frauds, about changes in the business activities, changes in the internal controls. how financial statements were prepared. So we have divided in three parts, guys. This can be very big source of information: past records and data, current year data, inquiries and communication, inquiries about frauds, changes changes in business activities, changes in internal control, okay, and the process. That can be good source of information for upgrading and updating information with us. If not yet perform the audit, that's absolutely fine. Okay, then you yourself understand the entity and its environment, including internal control systems. This understanding is very important for determining nature, timing, extent of audit, nature, timing, extent of procedures to be performed, review procedures, sorry, not audit, review procedures. So this was the question which was asked, guys. See, as I said, only few things are different, rest everything is as per standards on auditing only. Inquiry and analytical procedures are most important. Ordinarily, no inspection, observation, confirmation required, no. But then depending on circumstances and risk of material misstatement involved, you may perform other procedures as well. Ordinarily, no need to perform inspection, observation, confirmation. So how we perform the review? Ordinarily, we go and see the past audit. We see what happened in the past, what were the issues and problems, what were the issues in the previous. We go and see and their status in the current audit and review. We see the past first. Then we see in current year what important meetings have happened, what decisions, what are the financial impacts of the board of directors meeting, shareholder meetings, board of director meetings, are they properly implemented and followed? Then, so first get the past modifications, what happened in the present, and then you go and speak to people who are preparing financial statements. Whether framework is properly followed, understood, principles are selected, implemented, estimates are properly calculated. In critical matters like complex issues like business combination, related party, uncorrected misstatements, queries. So critical matters, you go and do inquiry about how things are prepared, about the critical matters, about the frauds and non-compliances, changes, big changes in the contract, principle, methods. So do this inquiry, perform analytical procedures, communicate with other auditors, review overall interim information. That's how you perform it. You go for the past, you look into current, you go for inquiry, how the preparations are there, critical matters, frauds, non-compliances and changes, analytical procedures, communicate with others. Timing of review procedures. It can be before or simultaneously. Very important. Review should start before financial statements are prepared or simultaneously, so that you are doing it early, you are early identifying the issues and matters, you are having sufficient time later to perform your review. It should start early or along with that. Both audit and review can happen simultaneously. That was extremely important. Both can happen simultaneously. Extremely important. Then same thing, litigation claims, do inquiry about it. If there is risk involved, go for direct, increase audit procedure, go for direct communication with the lawyers, go for letter of inquiry and so on. Same lines. There should be substantive audit procedures at the end to go and check at the end to reconcile whether information accounting records and trial balance and financial statement, whether they agree with each other. Subsequent events up to date of review report, we are supposed to check whether all the adjusting events are properly accounted for or disclosed. After that, we are not responsible. 570, look for things which create doubt or going concern. If yes, then probe further, go into going concern issue. We should always see whether the going concern issue is all fine, whether there are any changes. Okay, whether there is any change, you should go and see whether there is a doubt. If management has all plans and action, then no need to corroborate, go further. This is not audit, this is review. If they have plans and prima facie they looks good, proper, no need to further corroborate and get evidences. management's plan. So yes, we should look for things which create doubt. We should get more information. We should find out whether the going concern assumption is appropriate or not. Now, potential material adjustment, just like mistake. If by performing inquiry you come across potential material adjustment, we will have to perform additional procedures. Same lines, more inquiry, analytical procedure, other procedures. Evaluation of misstatement. If there are uncorrected misstatement, individually or aggregate their material, or there is an inadequate disclosure, then we'll have to modify the conclusion. We'll have to modify the conclusion, guys. Now, written representation, we have already discussed. We have already discussed about written representation. There was a shortcut also for written representation. What things should be there in the written representation? Franks, NGO, same things here also for written representation. See the shortcut of 2400. Then this is, guys, again 720. We should go and read if there's a accompanying, if there's an annual report along with review financial statements, interim financial statement. If other financial statement, if other information is there, we should read it. See about the material inconsistency. If adjustment is required in interim information, go for it. Okay. If amendment is required in other information, go for it. And depending on whether management is agreeing or not. Okay. So we'll have to take steps. We'll have to modify the opinion if required, withhold the report if required, or withdraw from the assignment. Different things are possible. So read other information, look for inconsistency. Sometimes a financial statement may need amendment. Sometimes other information may need amendment. If they deny, we may think about modifying the conclusions, withdrawing, withholding the reports. Other information, you read other information. If there's a material misstatement, discuss with management, consult with third party. If they still refuse, they are not ready to rectify, okay, we may think about withdrawal. And if there's a confusion, we may take a legal advice also. Copy paste like 720, guys. Everything is like 720. Now, communication. So if you come across misstatements, material misstatement, go and communicate to the management, appropriate level of management. If they rectify, great. If they did inappropriate response, go to TCWG. Even TCWG, there is an inappropriate response. We have to modify the report or think about withdrawal. It happens at the early stages, withdrawal. Later stages, we may think about modifying. So first communication is about material misstatement. Material misstatement. Next communication is about fraud or non-compliance. Go and communicate with them. Communicate. If there is something which helps them in governance, go communicate with them. It can be oral or written. Depending, if it's a significant, important matter, it can be in writing. Whatever oral communication we have done, it should be documented. So first communicate about misstatements, then communicate about frauds, governance issues, and then we discuss the modes. Report is again title, addressee, there will be introductory paragraph, intro paragraph, management responsibility, auditor responsibility, how we conducted, explain how we conducted the review. It is different from audit. Okay, not in detail, that much detail, we are not expressing audit opinion. Then the conclusion, nothing has come to our attention. We says that financial not as per framework, not giving true and fair view. Signature, date, place, UDIN. UDIN is required everywhere, even if they don't specify all the reports and certificate. Copy paste, same format. Departure, material adjustment not done. We have to qualify or give adverse. Copy paste 705. No adequate disclosures. Qualify or adverse. Limitation of scope, same. You go to management, they don't agree. You go to TCWG, they don't agree. You have to consider whether it is depending on materiality and when modifying the report or withdrawal. Further, they're elaborating. Before acceptance, if there's a limitation scope, if you feel that an auditor will not accept a review if preliminary knowledge indicates limitation on scope of review imposed by entities management. If very big imposition, don't accept. After that, go to the management, remove the limitation. They don't agree, go to TCWG. They don't agree, take the effect on the report. And you may think about withdrawal also. So first they explain in general, what if there is a limitation on scope? You should go to management TCWG. What if it is imposed by management? There can be situation also. There can be floods, tsunami, raids, government action. You're not able to. Other limitation. Other limitation on scope. In rare case where the limitation is confined to specific matters, we have to modify qualification if required, disclaimer. Same lines, guys, nothing new. Going concern and significant uncertainties. We know that if going concern depends on happening or non-happening of future events, okay, then that's called material uncertainty. That is called as, guys, material uncertainty, and it may carry forward from the previous. And management need to disclose in notes to accounts, and we need to disclose in our report. Now, there's a very interesting point out here. Okay. As per 570, we are supposed to put MUGC, material uncertainty of going concern. And it is considered we are just putting MUGC, it is considered unmodified report. But as per 24002410, if there is a material uncertainty of going concern, you put a EMP. It's old, guys. It is little old. In the old context, if there is a material uncertainty, we used to put EMP. And when you put EMP, it is considered modified report. But opinion is unqualified. So earlier they had the concept of modified report and then modified opinion. When EMP or OMP comes, it is called modified report. But opinion is still unqualified. Only the way that it is presented differs, guys. If there is a material uncertainty, okay, we'll ask for disclosure. If they do no proper disclosure, we qualify or give adverse. If they do proper disclosure, we put a EMP. We put a EMP and we put EMP for that. Now, issuance without review report. If the financial statements are issued and they are said reviewed without report, take legal advice what to do. We to inform people that reviewed financial statements are circulated. Very important, this is actually. We have to take action and inform everyone. We may go to public notice that our report was not circulated and go to AGM and speak about it. Now, very interesting. This is very, very interesting. Reviewed financial statements are circulated, but a modified report is not circulated. We'll take legal advice what to do. And we may think about resigning from audit of annual financial statement. Now, this is very interesting. There's a problem with review and you may think about resigning from the audit. There's a problem with review. See, if your financial statements are reviewed, the review report should be circulated. If it is not circulated, take legal advice what should be done. If a modified report is not circulated, it's a very big thing. You may think that let's leave their audit. We have lost faith on these guys. What do you mean by condensed financial statements? Condensed financial statement means only having, summarized means everything is there, only details are reduced. Condensed means only important income, expense, asset, liabilities are there. That's called condensed. Interim financial information can be in the condensed form. Only significant events and changes can be there. It should be always specified in the report wherever there is a condensed financial statement that listen, only significant events and changes are there. Not all. It should be always read in conjunction with latest audited financial statements having all the details. Absence of such statement may lead the auditor to information misleading and assess implication on review report. So whenever condensed financial statement, if you are doing review of condensed financial statement, this statement should always be there in the financial statement, that it should be read in conjunction with the detailed financial statement. If it's not there, people will get confused, there will be misunderstanding. What to document? Document all document to prove that our work was performed as per review engagements. Our work was performed as per review engagement, and we have obtained sufficient appropriate evidence to support our, ensure we have enough evidence to prove that work is as per law, rules, regulations, standards, and we have enough evidence to support our conclusion. Let's take a 5-minute break and we will do one more chapter. Very interesting one. Then we'll see chapter number, so we are through with chapter number 8, we are through with chapter number 9, we are through with chapter number 10, and we'll be doing chapter number 11. Okay, guys, we are back and now we are focusing on chapter number 11. Chapter number 11, it is going to have three standards, 3400, 3 standards in chapter number 11. It is 3000 series. It is 3400, 3402, 3420. Okay. Let's see some background. We already know we have engagement quality standards. Engagement and quality standards, guys. In that, for different types of assignments, we have engagement standards. Then for when we comment on reliability of the information, we have assurance services, related services. When we do audit of historical information, that is in financial information coming from books of accounts, we follow essays. When we do review of historical information, we follow SRE. For related services, we follow SRS. If we're doing audit or review of information other than historical, if you're checking anything which is other than historical, that means anything which is other than financial information coming out of books of accounts. If you're checking anything, any information other than which is coming from books of accounts, okay, then that is other than historical information, anything other than books of accounts, then you apply SAE, standards on assurance engagement, and we have 3 standards for that. The first standard we start with is 3400. 3400, and says very simple thing that people are apart from expecting audit reports on historical information, people are expecting us to give report on prospective information, on futuristic information, prospective balance sheet and P&L. So futuristic prospective information means financial information about the future next 5 years balance sheet, P&L, cash flow statement, notes to accounts, and so on. Okay. So they are saying that when it comes to assurance engagement, when we comment on reliability of the information, which increases confidence of the people, then they use information more confidently. Okay, then that's called assurance engagement. In assurance engagement, we can comment on reliability of historical information also, and anything other than historical also. That means outside books of accounts also. So it is going to cover other than historical, and that's why we have this 3 standard: 3400, 3402, 3420. Okay, 3400 is prospective information. The prospective financial information is nothing but information about financial information about the future income, expense, assets and liabilities, future balance sheet, P&L and cash flow statements. Okay, this examination can be performed by anyone, need not be the auditor of the company. That's very important. The person need not be the regular auditor of the company. Any chartered accountant can do this particular examination. It is futuristic information. It is prepared on the basis of assumptions of what's going to happen in future and what management is going to do in future. We assume whether market will grow, what will be the market share, how many players will be there, what management will be doing. We take assumptions about the future events and conditions, future management actions, and on that basis we prepare prospective financial information. There are 2 types of prospective financial information. One is called forecast and other is called projection. Forecast is prepared on the basis of best estimate assumptions. It is prepared on the basis of best estimate assumption. We sit with historical data, present circumstances, and then we think what in future, what is expected to happen, expected future events and condition, what expected management actions are going to happen. So on that basis we find out best estimate assumption, most realistic assumptions, and on that basis when we prepare something, that's called forecast. So we know the past 5 years growth has been 5%, and then simply we apply that turnover will increase by 5% in future, and then we compute forecasted P&L. We compute P&L, that will be called as forecast. Then what do you mean by projection? Projection is prospective information, futuristic information. It is It is computed on the basis of hypothetical assumptions. What do you mean by hypothetical assumption? Hypothetical assumptions, hypothetical assumptions are assumptions which are not expected to happen in future. They are not expected to happen in future. They are not expected management actions. Okay, they are not necessarily expected to happen in future. Expected management action, as name suggests, hypothetical assumption means any assumption what management feels, so that they can evaluate different types of scenarios. What if we start exports? What if we start new production? What if we go for amalgamation? What if we go for merger? We think all these things and take hypothetical assumption. That's called as projection. Projection can be made to explain investors it can be made to explain people what kind of growth new products, new services can bring. Hypothetical assumption can be taken to explain equity investors what if their money is invested, what will happen. Okay, it can be used to explain bankers what will happen if their if loan money is taken and implemented in the business. So the basic difference is, if after covering everything, historical data, present situation, circumstances, lot of research, what's going to happen in future, what management action, that's called the best estimate assumption, then that PFI, that prospective information, is called forecast. If it is based on hypothetical, if we simply want to analyze what if scenario, purpose is just to analyze situation, and we take hypothetical assumption, not necessarily expected to happen, condition expected to happen, expected actions of the management, they're not expected actions. That's called projection. Okay, I hope you got a clarity. Something which is very realistic, which may happen in future, is forecast, and something which is prepared just for analysis based on hypothetical assumption which are not necessarily expected to happen, or action which management may take, that's called projection. Now, what to check? We standards on assurance. If you want to check prospective information, it can be in the form of forecast or projection. It is covered in SE 3400, this kind of checking. But if your prospective information is in the form of narrative, is in the form of general or narrative terms like management discussion. See, if your prospective information is in the form of balance sheet, P&L, cash flow statements, that can be evaluated and report can be given on that. But if your prospective information is in the form of paragraphs, narrations of what things will happen in future, that is not covered in this standard. Okay. And when you execute this standard, if required, you can definitely apply principles of standards on auditing. So it's very open-minded standard. It says that you apply our principles, and if you want, if there is a confusion situation, you can follow principles of standards on auditing. They use the word auditor. The person checking it can be auditor, may not be auditor, may be auditor. Okay. Now you need to understand that the nature of the information is prospective, futuristic. What's going to happen in future? It is based on assumptions. Okay. Based on assumptions. Historical information is based on evidence. In contrast, this is based on assumptions. And when we express, that's why. So see, they're explaining. Prospective information is futuristic, is based on assumptions, is not based on hardcore evidences or books of accounts. And that's why we cannot give opinion on them. Yeah, we don't give opinion on prospective information. Then what we do, sir? We talk about the assumptions. We talk about the assumptions. We talk about how reliable assumptions are. We cannot vouch accuracy of prospective information. We cannot give guarantee. We cannot say this is going to happen. No. We can at the max comment whether the ingredients and the assumptions, are they reliable or not. That's it. Are they reliable or not? That's what we can comment on. Okay. Let's understand, guys. Responsibility management is fully responsible. Management is responsible for preparing prospective information. They are fully responsible. They are supposed to collect historical data. They are supposed to think about what's going to be the data for computing assumptions. They are supposed to apply assumption on historical information, compute prospective information, okay, make notes to accounts, disclose everything. It is completely management's responsibility. We are supposed to give report on that, and that too we cannot give guarantee, we cannot vouch accuracy, we cannot comment on output, we cannot guarantee this is going to happen. We simply comment whether the assumptions are reasonable or not. That's it. Okay. So our responsibilities, what is duty of the member? What is our duty? Our duty is very simple, straightforward. Our duty is we don't comment upon, we don't vouch accuracy of the information, accuracy of the financial statement, what's going to happen in future. No, not at all. Then we simply talk about the assumptions. If it is best estimate assumption, we talk about reasonableness of the assumptions, whether they are reasonable, realistic, whether really such things may happen in future. We talk about that. If it's a hypothetical assumption, so hypothetical assumption is, what if I make a new plant? What if I make a new plant? That is a hypothetical assumption. New plant for production. So we go and check consistency with the purpose. Suppose you are saying that I want to evaluate a scenario that we are opening a new plant. So, okay, so for this particular scenario, a new plant, you're doing a hypothetical assumption. You want to evaluate a situation where a new plant is open. Your main assumption is that we are opening a new plant. You are going to need a lot of more assumptions to support the main assumption. Opening new plant, we need to then you are assume that you are opening a new plant, so you will need a land for that. You need to assume that you are buying a land. You assume that you are taking a loan. Or you are issuing shares for that money. We need to assume now that the production will happen. We need to assume that it is going to get sold. So for one what if scenario, for one main assumption, a lot of more assumptions should be there. They should be consistent with the purpose. Assumptions should complement each other, should be consistent, appropriate. Okay. So one hypothetical assumption will be there, and you need to take a lot of assumptions supporting that. And at a time take one what if scenario only. Don't take multiple what if scenarios. So it's our duty to evaluate the assumptions, if it's a reasonable, if it's a best estimate, when it's reasonable, realistic. When it is a hypothetical assumption, we go and see what is the main assumption, whether all other assumptions are adequate and consistent with the main assumption and the purpose. That is our duty. That is the most important duty. Then next, the most important thing is assumption. Then the next is you need historical data. You need data of previous financial year or average data of plus 2-3 years. We go and see whether that data is complete, accurate, what are the accounting principles used, whether those accounting principles are used in the prospective information also. So we go and see whether the base data is appropriate. Then whether the assumptions are properly applied and expected revenue is properly computed, expected expenses, expected assets, liabilities, cash flows are computed, and then notes to accounts. So most important, we focus on assumptions, then we focus on historical data. Is it complete? Is it accurate? Is it complete and accurate, properly calculated? Whether there is a consistency of accounting policy of historical data and prospective information? Then where the calculations are proper. See, it's in a flow, guys. It's in a flow, it's in a sequence. Presentation disclosure is appropriate. Then next is, now very important, they have asked this question a lot. People will come to you with any kind of prospective information. You should be extremely careful. People are going to come to you with any kind of prospective information. You should be extremely careful about that. You should be extremely careful when you think about accepting this particular assignment. Okay, let's understand this, guys. So before acceptance, you need to see some points. Urban Den is the show. Before you, people will come to you with with a lot of prospective financial information that you examine and give report on it. You should be careful before accepting. What things you should focus on, okay, before acceptance. U stand for use of the information. If they are planning to, they are coming up with IPO or a business, they are coming up with IPO, or they are coming up with a new business, and they are making this prospective information to convince investors of the high growth, so that they should put loads and loads of money. If you think that this information will be used and presented in such a manner that this is going to happen, and they are promising unrealistic gains and lot of things, okay, if you think this information is going to be misused to fool investors, to fool people, you should not accept it, okay. Then distribution. You feel this information will be given to every damn person, even to people who may not understand it properly. Instead of giving it to only some people who understand that it's a prospective information, again there is a misuse, okay, misuse. Don't accept such assignment. Then E stand for elements in the information. If it's covering financial information, great. If it's covering a lot of non-financial information which you don't understand, don't accept it. Then nature of the assumptions. If you feel that assumptions are, if it's best estimate assumption, you feel that prima facie they are realistic, reasonable, great. And if it's hypothetical, there is one main hypothetical assumption, the purpose, and they prima facie they appear good, fine. If they don't appear good, don't accept. So urban den will decide whether to accept the assignment or not. Use of the information such that it will be misused. Distribution will be to a lot of people who should not be receiving, don't take it. Elements of the information, non-financial, they are talking about 20 years, 30 years, 40 years, that's not possible, don't accept. And nature of the assumption is not good, assumptions are not proper, don't take it. Before accepting, be careful about these 4 points, then only accept, okay. If you come across unrealistic assumption, reject it. If later on after accepting you feel that assumption unrealistic, withdraw from the assignment. So that's very important. You be careful when you accept this assignment. This has been a very famous question in future, famous question in past. Then, so first look into this important things. Then you also see whether realistic, whether historical information is realistic. So in acceptance, there are four important points about 4 important things to look into. Then also link into historical information. Are these guys having reliable historical audited, reviewed, reliable historical information which will be used for preparing PFI? If not, don't accept. Are they ready to make agreement, important terms and conditions? If not, don't accept. So before accepting, look for some factors. Okay. Then look for the historical information. Then look for the terms of engagement. If these 3 things are there, if these 3 things are not there, don't accept. What kind of examination procedures? Now, nature, timing, extent. Nature, timing, extent of the examination procedure will depend on nature, timing, extent of examination procedure. Nature, timing, extent. Nature, timing, extent of examination procedure. Of examination procedure, guys. NTE, nature, timing, extent of examination procedure will depend on some of these factors. SBGen made technology for prevention and money laundering. Superb. So, examination procedure will depend on technology. SBGen technology. S stand for source of information. Source of information. We have to carefully see what is the source of information. What is the source of, from where the information and data is collected for preparing assumptions. Okay. From where this information is getting collected. Is it only our historical data? It is industry data, verified data, published data, okay, third parties. If the data is only our source is there, It is not industry data, not verified data, not published data. You have to work hard. So we have to see what source of information. A lot of internal source of information is there, or a lot of external source of information is there. And if it is there, if it's internal, how good are the internal control system? Is it external? How reliable the parties are, and what kind of reports are there? Look at the source, base source of the information. If source of the information is not pretty reliable, nature timing extent will be more. Then SBGen, B stands for business. Stability of the business. If the business is pretty new, it's not very stable, then it's very difficult to predict it. Then we have to work hard. NT will be more. SBGen, judgment. If less of data and more of judgment, when data reduces, we have to make more and more and more and more of judgment. We have to use a lot of judgments. If there's more judgment is used, NT will increase. SBGen made technology. Team's experience. If the team who is evaluating it is not that experienced, that it is their initial assignment, they don't have enough experience of the industry, of the business, or such kind of assignment, more NT. We don't have any previous engagement with this industry or entity, more NT. Management is not very competent in preparation, more NT. There's a likelihood of material misstatement, more NT. So if the source is bad, if the business is source is bad, business is unstable, lot of judgment, team is not experienced, previous assignments were not performed with them, management competence is low, likelihood, we need to perform more NT. Important one, guys. This is important. When are we supposed to perform? When are we supposed to perform more NTE? Now, they are giving example of best estimate assumptions. In best estimate assumptions, the data may come from the past year's data, budgets, entities' own budgets, industry publications, etc. Hypothetical, okay, assumptions can be what if scenario. It can be anything which management thinks about beyond normal. We in hypothetical assumption, we simply have to see what is the main hypothetical assumption, what is the purpose, and whether all other assumptions are adequate, covering every damn thing, are they consistent with each other. We already discussed this. Now, very important is notes to accounts. How good are your notes to accounts? That's very important. How good are your notes to accounts? Okay, when we talk about presentation and disclosure, how good are your notes to account is extremely important. So dharna, political dharna, you must have heard, to protest. So dharna factors. If you want to check presentation and disclosure, look at dharna factors. Date. You should always go and see that PFI date should be clearly mentioned as on which date this PFI was prepared. So it will be very important that information and knowledge as on which date was considered while preparing these prospective financial information. Date is a very crucial important factor. It should be highlighted, properly highlighted, that this was prepared on so and so date, and information and things up to so and so date were considered while preparing it. Then, very important, accounting policy changes. In presentation disclosure, whether there is a change in accounting policy in PFI as compared to historical information. Questions are asked on this. If there is a change, historical accounting policy was different and then its PFI accounting policy is different, it should be justified change, why it was changed. It should be presented and disclosed properly, notes to accounts. Go and see whether historical accounting policy has changed. Then A stands for whatever is the present accounting policy, it should be disclosed clearly so that people are able to understand what accounting policy these guys are using when they want to make comparisons. Then range. Some data can be in range format, higher side, lower side. People may specify this maximum, minimum. These are the data and these are the max. So apart from giving the data of income, expense, asset, liability, people may give range also. There's minimum, maximum. It should be specified on what basis minimum and maximum is calculated. How it was calculated. What was the basis? Okay. It should be specified. When you compare, economy will boom, economy will go down. How you have compared both? Whatever presented should not be misleading. It should not be misleading. Okay. Now you are writing total profit and you are adding profit of 5 years and not explaining that it is 5 years. It is misleading. See whether any terminology or data is misleading. And most important, whether assumptions should be clearly disclosed, that these are the best estimate assumption, these are the hypothetical assumption, it should be clearly disclosed. So what are we supposed to see in presentation disclosure, dharna? Whether there is a date, whether historical statement, accounting policy, and there is a change, whether existing accounting policy, range, what is the base of range, not be misleading assumption. Then the format of the report, there should be a title, very simple, first title, after title there should be addressee. First there should be a title, and after title there should be addressee. Then you are supposed to identify. That okay, this is a prospective information of so and so entity for so many years, identify the information. Then there only you can explain with intro, purpose and distribution. This is there for the bankers, this is there for the loan purpose or IPO purpose. This is there for valuation, amalgamation, merger, and for whom it is there. You specify that also. Okay. Then it is management responsibility to collect the historical data, to make all the assumptions, to apply them and prepare financial statements. Then like auditor responsibility, this is like auditor responsibility. This is like auditor responsibility. So we need to give reference. That this assessment is performed as per SAE 3400, and then you explain that we perform this on test basis, and what we have checked is whether the assumptions are reasonable and real, whether the data supporting assumption is reasonable, realistic, and whether assumptions are properly applied and calculations are done. That's what we have checked. And then like opinion, you say that negative opinion is there. Nothing has come to our attention which suggests that assumptions are unrealistic. Nothing has come to our assumption that the best estimate assumptions are unrealistic. And if it's a hypothetical assumption, we don't comment about hypothetical assumption because they are hypothetical, they are unrealistic. They are not expected to happen. And then we also tell whether they are properly applied, whether the assumptions are properly applied in preparation of financial statements. Okay. Then we alert people that even if all the assumptions come true, new situations and circumstances may arise, a new tax may come, a war may happen, and the desired results may not be achieved. Okay. So, and then finally signature, date, place is there. So guys, first comes title. So it can report on prospective financial information, addressee, identify what PFI is covered, what is the purpose, distribution, then management responsibility, then auditor responsibility, then auditor's responsibility like perform as per the standards, what we have examined, then finally opinion, negative way we give the opinion, signature, date, place, guys. Now we have to write more things. See, people may misunderstand this report, so we need to clarify more things. So Parul Vora is making this report. Okay. If there are projection, we should clearly specify the intended use. Intended use, that it is for a what if scenario, what if we make a plan, what if we start export, what if amalgamation happens. So we explain the what if scenario, We explain it is based on a hypothetical assumption. We explain people that they are not expected to happen. These are not expected events and condition, expected management actions. Then we tell people that even if everything goes true, the actual results may be different. From the actual result may be different from what were in PFI. Be careful. Don't rely blindly. And we don't express opinion on expression of regarding correctness of prospective is in line with assumptions, and in presentation we give opinion on the assumptions and their calculation, not exactly that this is going to happen. We always explain people about the range uncertainty, that some things are based on range, how range are calculated. State where the grounded in evaluation of evidence supporting assumption, anything has emerged which leads to believe that assumption may not be reasonable. We talk about whether the assumptions are unreasonable. So guys, in report, we would include all these things, that we will talk about projection in depth, and let people know that these are hypothetical in nature. What do you mean by hypothetical? We'll tell people that results may be different. We'll tell people that we are just talking about the assumptions and calculation, not the complete thing. We tell people about range uncertainty and unreasonable assumptions. Do we modify? Of course. If there is limitation of scope, management is not giving us sufficient appropriate evidence, we'll modify. Or if we find out that there are unreasonable assumptions. So just like in audit, we have inability to obtain sufficient appropriate evidence. Inability to obtain sufficient appropriate audit evidence. Okay. So audit evidence, or there's a material misstatement on the same lines. If there's a problem, if there's a limitation of scope, okay. Management is stopping you from getting the information, we may modify. If the assumptions are unreasonable, we may modify. So, if they are not giving you information, we may think about withdrawal or disclaimer of opinion. Withdrawal or disclaimer, very harsh. If the assumptions are not reasonable, we may think about again withdrawal or adverse opinion. They are not thinking about qualification. They are going for extreme. As such, things are futuristic, and in that there is a mistake. As such, there is a big chance that people will get confused. So they are saying directly go for disclaimer or withdrawal, or adverse or withdrawal. Initial stages we may go for withdrawal. Okay. If there is a problem with big problems, if there is a problem with presentation and disclosure, then there is a comparative small. People may go for qualified, adverse or withdrawal, as the case may be. So see, in the earlier cases, they were talking about disclaimer and withdrawal, adverse and withdrawal, and disclaimer, withdrawal and adverse. Here they are talking about qualified, adverse and withdrawal. Early stages it is withdrawal, later stages you report. Document every damn thing. You need to document that you have performed your audit, you performed your assurance service as per the given standard properly, systematically. You should have sufficient evidence to support your conclusions with respect to assumptions. So there should be sufficient document for that. That is 3400, guys. Some of the things are very important. Whatever I have marked in pink star is extremely important, guys. Then assurance reports on controls. Assurance reports on controls at service organization. Now this is very interesting, guys. Now you should be aware about a very simple terminology. Let's understand, guys. Now entity which uses from services from outside, that's called user entity. Entity which uses services from outside, they have outsourced their work to through third party. They are using services from outside. They are using services from outside. It is called as user entity, and the auditor is called as user auditor. And the entity which is giving this service is called service organization, and its auditor is called as SO auditor, service organization auditor. If user entity auditor is doing audit of user entity, he need to follow 402. He need to follow 402. 402, guys. And if service organization is preparing any report, then its auditor, SO auditors, will have to follow SAE 3402. So there are two standards, guys. Let's freeze. There is a user entity, user auditor. There is a SO, service organization, SO auditor. User entity auditor will follow 402 and they will follow 3402. Okay. I'm assuming that you know about 402 now. Let's see, guys. Let's understand. Just a minute. See, this is a very simple example. I will quickly take you through with the example. Very simple. So here we have a user entity, and they used to have a big salary processing department of 20 people. Now they have closed that department. Now there is very simple clerk. He performs step number 1. He makes all the appointment letters, transfers letters, retirement letters, termination letter in triplicate. Sends approval to the HR head. HR head approves it. It goes to the CFO. CFO team reviews it, and again it is approved from there. So clerk prepares it, then HR head, then CFO. 3 steps are happening at user entity. They are now first copy goes to employee, second copy is retained, third copy goes to step number 4. It goes to service organization. So the salary processing activity is outsourced to service organization. In service organization, Ramesh receives the envelope and calls the clerk whether these were the number of document you have sent and so things. He confirms it. That's called communication between them. So Ramesh receives and confirms the information. Naresh types it and converts into electronic file. Mahesh checks the file and uploads it for processing, updation. Step number 8, updation. Hitesh starts processing monthly salary and sends final report. And finally, step number 9, Ganesh, he reviews the final report. So guys, basic data is generated in user entity and it is sent to service organization who is doing salary processing. And Ramesh does the thing, verifies, Naresh converts, Mahesh updates, Hitesh does the processing, Ganesh reviews, a final email is sent. Management confirms the data again, whether number of employees are proper, checks 10 employees and then approves it. Then step number 11, payment is done. So the entity on the left side is called user entity, and then we have service organization. Now the question is, step number 1 to 4 are called, these steps are performed at user entity, and because of these controls, information is complete and accurate. They are helping service organization in better processing. That's why it's called complementary user entity control. Complementary user entity control. 5 to 9 is called internal controls at service organization. 5 to 9 is internal controls at service organization. What steps are performing at service organization? Step number 10 and 11 call that internal controls at user entity. There is always a risk involved in outsourcing. To compensate that risk, internal controls at user entity. So 3 types of steps are here, controls are there. Now, we always have a doubt. We always have a doubt whether the service organization is performing its steps properly or not. So we ask service organization that you prepare description of internal control system. You prepare flowchart and description 20-25 pages. What steps are performed by what person, how you ensure completeness, accuracy, confidentiality, secrecy, and so on. How you ensure everything. You prepare a document and ask your auditor or any chartered accountant, your auditor, SO auditor, or any chartered accountant you appoint to check this description, check this 20-25 pages. Are they appropriate? And send report, type 1, type 2 report to user entity. Now listen guys, if user entity auditor wants to audit financial statement, he will follow 402. If SO auditor is checking this description 20-25 page document, okay, he is not checking financial statements, he is not checking historical data, he is taking a flow chart that is covered by SE 3402. And 2 types of reports can be issued, type 1, type 2. First I am explaining type 2 report. In type 2 report, listen guys, auditor comments whether the description, the flowchart about the internal control system at service organization, whether this description is appropriate. Okay. See what happens. Now listen guys. What is type 2 report? In type 2 report, there is a description of internal control, there is a flowchart. Okay. There is a flowchart. Management responsibility is to prepare it. Management write a lot of things in that. Auditor responsibility is to check it and gives opinion whether the flowchart is fair. Is it revealing the truth? Is it a fair description? Is it suitable for such kind of processing? Whether the description is fair, whether design is suitable, and is it operating effectively throughout the year? So in type 2 report, 3 things are said: whether description is fair, whether design is suitable, whether it's operating effectively. In type 1 report, only one last point about operating effectiveness is not there. Okay, I hope you got the idea. This is the base for 3402. This is the base for 3402. So it's very simple. Let's understand this, guys. Let's understand. Introduction is pretty simple, straightforward. 3402. If SO auditors or other chartered accountants are preparing report on the description of internal control system, only those controls which are relevant for user entity, financial statements, then for preparing such kind of reports, you apply 3402. Okay. It is to support and complement the information requirement in SA 402. Auditor will need a lot of information 402. To support it, to complement it, we have made 3402. First 402 was created, and to support it 3402 was created. Okay. So let's freeze, guys. If you are preparing, if you want to give a report on only those controls which are relevant for the user entity in preparation of financial statements, it's having impact connected to it, then only 3402 is applicable. Okay. So it's very specific thing it is covered. Service organization prepares the description of internal controls and auditor comments on it. Is the description reliable? Okay, then it is applicable. Now, this standard is not applicable. Suppose there are internal controls at service organization. See, service organization will have different types of controls. If you want to comment only on those controls which are relevant for user entity financial statement preparation, 3402 is applicable. If any report is prepared on internal controls of service organization, this standard is not applicable. Then that is an internal audit. If you cover any internal control and you want to make a report on that, this standard is not applicable. This standard is not applicable if the report is on the controls which are related to production or quality. Only if it affects financial statements. Let's freeze, guys. Service organization is doing a lot of activities. It is having steps and procedure controls. If report is prepared on any control of SO, 340 is not applicable. If report is prepared on SO steps and controls which are related to production quality and not financial statement, again 340 is not applicable. It is applicable only in specific situations. Specific situation. What specific situation? Only specific situation when controls are relevant for financial statement of user entity. So any entity which is performing the steps for user entity, performing the controls of user entity, giving the services, that is service organization. Any entity whose work is done by service organization, whose controls are executed by service organization, that's called user entity. Okay. Why controls, this heading is not proper. Controls at service organization. See, instead of why, which controls? See, it's very specific. Only when service organization is doing some work which is related to financial statement of user entity and report has to be prepared on that, only that time 3402 comes into action. So those steps and controls should be relevant for the user entity financial statements. Okay. Only when controls at service organization are related to financial statement of user entity, related to the income, expense, asset, liability or financial statement preparation somewhere, then only they are relevant and covered by 3402. Example, payroll processing, which I just took. If you are computing payroll, it is directed to the particular expense, it becomes relevant. It becomes relevant. Those controls become relevant. So, these are giving some basic information. Steps which are done at service organization, which are connected to user entity financial statements, they are called controls at service organization. In our example, from what Ramesh, Mahesh, Suresh, Hitesh, Ganesh were doing, that's called controls at service organization. Only if they are connected to financial statement, they are relevant. Okay. If they are not connected to financial statement, they are unrelated, not covered in 3.4. So in initial portion, they are focusing on one thing, that only some controls which are having impact on the financial statement, they are called relevant controls. And if you want to give report on that, 3402 is applicable. The auditor of user entity is user auditor, the auditor of SO auditor, service organization is SO auditor. Okay. Now, objectives are, guys, objectives, this means target which are set. Okay. Target which are set for the auditor, service organization auditor. Service organization auditor has to check whether the description of internal control system is fair, it is realistic, description is fair, whether the design is suitable, is it capable of doing proper, calculation, proper steps for the given purpose, is it suitable, is it operating effectively, and then make a report on it. So objective is pretty simple, check 3 things and make report. Now it is type 1, type 2 report. Let's understand this, guys. In type 1 report, first you will get description of 10, 20, 25 pages, the flowchart on how processing is done at service organization. And in that description, they are going to write, management is going to assert, it is a fair description of internal controls at service organization. They are going to write that design of the system is suitable for such kind of processing. It is good for such kind of processing. It is achieving the control objectives like completeness, accuracy, confidentiality, etc. And now auditor has to check these description, these assertion. It is a fair description. Is it suitable? And report on it. In type 2 report, there is only one addition in type 2 report, operating effectiveness. In type 1 report, we only talk about fairness and suitability. In type 2, we talk about operating effectiveness also. So whether the description, type 2 report, see, type 2 report has a description, then management's assertion about fairness, description, fairness, design suitability, operating effectiveness, and then SO auditor's report, whether these three things are appropriate or not. Type 1 report is not talking about operating effectiveness. Type 2 report talks about operating effectiveness. Okay. So if you are appointed as an auditor and you are supposed to check this description, you are appointed as an auditor, okay, and you are supposed to check this description. You are supposed to check this description. You are supposed to check this description whether the type 1, type 2 report is appropriate. What steps you will perform? Customize WhatsApp. So for checking, I will need customized WhatsApp. First of all, need to ensure that the auditor and its team are complying with ethical requirement and they're independent. So first ensure that they and their team are ethical, they fulfill all 5 principles of ethical requirement as per code of ethics, and they're independent. Then next, they are supposed to understand they need to understand service organization system. They need to understand how service organization works. What kind of steps are there, and understand what kind of steps they perform. Suppose salary processing, what steps they perform and how they perform, obtain the understanding of the system. Then criteria. It's like financial reporting framework. You need certain benchmark, certain basic principles against which we need to evaluate the description of internal control. So we need criteria. Okay, so there can be international criteria there. So criteria, you understand the criteria, the benchmark which is used for comparison, the basic principles and format which is used. Is it suitable? Is it made by recognized? Is it made by recognized body? Is it suitable? Then determine who are management and TCWG for communication purpose. Then is the system is really operating effectively? Go and observe, go and reperform, go and see document. Is it operating effectively? Also determine materiality. Level, because we are not interested in immaterial items. Understand internal audit function also. Internal auditor must have checked those systems, so his report will be useful. Look for subsequent events which happen after the description was prepared and the report is given in between. Understand what things are happening. Is there anything which is having effect on the description? Obtain evidence about the design of control. Is it really suitable for the salary processing? Get evidence about description, evidence about design, evidence about description. Ask for written representation. Confirm that description is fair, design is suitable, it is operating effectively. We have disclosed all the non-compliances and deficiencies to you. There are no subsequent events, adjusting events. Okay. And in the process, they may suggest changes in the agreement. If it is justified, you can accept the change. If not, you may withdraw. So guys, if you want to perform it, you need customized work. We'll comply with ethicals and independence. We'll understand the service organization. We'll see suitability of the criteria. We'll determine who are TCWG and management for communication. We'll check operating effectiveness, evidence about operating effectiveness, materiality, internal audit, subsequent events, evidence for design of controls, evidence for description, written representation. Many of these things are repeated. So if you want to forget the shortcut also, it's very simple. As you go in audit, first understand the internal first obtain the understanding. obtain the understanding, determine the maturity level, determine who are TCWG and management. Okay. Then you start getting the evidence about the description, evidence about the design, evidence about the operating effectiveness, about obtain the written representation if they want. So just like we perform a regular audit, if you keep that also in mind, you will be able to answer it. Then guys, next is reporting. So you are going to need title. You are going to need title. You are going to need addressee, title, addressee. Okay. Then you are going to need title. You are going to need addressee. You are going to need identification. Okay. First title. So report. Independent Service Auditors Assurance Report. Title, addressee. To user, to whoever concerned, it can be there. Whoever is the appointing authority, it will be addressed to them. Identify the description of internal control. That yes, we have done the audit of description of internal controls at service organization, only those controls which are relevant for the user entity financial statements. Only that we have covered. We have not covered all the controls at service organization. Okay. Control steps which are happening at user entity. We have not covered complementary steps which are happening at user entity, which are checking completeness and accuracy of the input. That is complementary user entity controls. User entity controls which are complementing service organization. We have not checked that. So introduction, you write what we have covered, what we have not covered. Sub-service organization. If service organization has outsourced its work, to sub-service organization, whether report covers work done by sub-service organization or not. For example, TDS work is outsourced, whether it is covered or not, activities of sub-service organization. Then like management responsibility, it is responsibility of management of service organization to prepare the description of internal control system. Okay, to prepare, to provide services to user entity, then to prepare description of internal control system, to achieve the control objectives, design, operating effectiveness, criteria, everything is management responsibility. So like management responsibility, you will prepare, you will design and implement the system. It is your responsibility. You will make the description. You will ensure design is suitable. You will ensure it is operating effectively. Okay. You will ensure it is as per the criteria. You will select the criteria as per the criteria. Then, like our responsibility, auditor responsibility. Our responsibility is to evaluate the description of internal control system as per SE 3402. We have our responsibility, whether description is fair, whether design is suitable. That is a responsibility we have performed as per SE 3402. We have obtained reasonable assurance before giving our report. We will summary of audit procedure, what we have performed. Then whatever checking we do, it their internal control and their inherent limitation. We want to explain about inherent limitations. There can be human errors. There can be collusions. There can be management override. Opinion. Positive form, whether description is fair, whether design is suitable, whether it is operating effectively. In type 1, only two things: signature, date, place. So here also guys, you have title, addressee, introduction, what controls are covered, what are not covered. Then you have management responsibility, auditor responsibility. Then you have the opinion, signature, date, place. Same lines. In type 2 report, you need to explain in detail how you have checked operating effectiveness of internal controls. You need to describe the complete test, what test you have performed. You need to report the deviations when system was not followed. There is obligation to report deviation. In report, you need to write the deviations. Even if deviations are less, then you need to say that deviations are not that big. We can still conclude that they are operating effectively. So you need to give more details about the what tests were performed, what deviations were there. It's mandatory. Can we modify the opinion? Yes. If it is no fair description, modify. No suitable, modify. Not operating effectively, modify. Unable to obtain sufficient appropriate evidence, again we modify. Document enough that as per assignment is performed as per law, rules, regulations, standards, and we have sufficient evidence to support our opinion. Document procedures, procedures, results, conclusions, everything. The last standard, guys, the last standard is 3402. The last standard is 3420, and it's pretty interesting. It is on prospective information. Let's see, guys, it's on prospective information. It's on prospective, pro forma financial information. So we need to understand what is pro forma financial information. Let's understand with an example. Okay. Suppose we are talking about financial year 24-25. So financial year 24-25, it starts on 1st of April 2024. Then we have year end 31st March 2025, and Flipkart is deciding to come up with the IPO, and they are planning to come up with the IPO. They planning to come up with prospectus on 30th of April. So after year end, there is a month involved. After a month, they are planning to come up with the prospectus. But after year end and before prospectus is issued, they acquired Meesho, which is a huge Meesho, which is around 30% of the Flipkart. They have made a very big acquisition. So many times this happens that companies are planning to go for IPO, they're planning to issue prospectus, and in between dates, very big events, very big transactions, events happen. Okay. Now, their ICDR, okay, SEBI ICDR regulation, ICDR disclosure their disclosure standards, issue related disclosure standards, issue related compliance and disclosure standards, and they say that if after a year and before prospectus any big change happens, something so big which is contributing to 20% or more, then you need to explain people impact of this. How will you explain the impact? So they have come with very innovative way. They say that do one thing. Take a hypothetical assumption that this event or transaction has happened on the first day of the financial year. That is 1st April 2024. You assume this. You make this hypothetical assumption. And now you prepare a combined financial statement making this assumption. Make a combined financial statement taking this assumption that things have happened on 1st of April. You take this assumption and you prepare combined See, this is how it will be prepared. First column will be Flipkart's financial statement. Next column will be Meesho's financial statement. Then there will be pro forma adjustments. Okay. What is pro forma adjustments? First of all, there will be adjustment required because of harmonization of accounting policy. Policies between both of them will be different. So the harmonization of accounting policy will take place. Then there will be adjustment related to this event. Because of this event, because of the acquisition of Meesho, amalgamation goodwill may arise. Intercompany transaction will be nullified, intercompany balances will be nullified, and so on. And for this transaction, there must be some loan must have been taken, some issue of shares must have been done. Okay. So transaction related adjustments will be there. what will happen, or transaction rate adjustment, what will happen because of this goodwill, capital reserve, intercompany balances, and financing because of transaction. Those, so if there is a financing, interest will come, and so on. Those adjustment will done. Together it is called pro forma adjustment. So harmonization of accounting policy plus transaction rate adjustment together is called pro forma adjustment. Now we'll add all of both of them, total adjustment, and when we add financial statement of Flipkart, Meesho plus pro forma adjustment, we get pro forma consolidated financial statement. Guys, this is not real. We have taken a hypothetical assumption and we have adjusted historical information and prepared a combined financial statement to show people what will be the impact, okay. So here we are taking hypothetical assumption and adjusting historical financial information. This is happening outside books of accounts. That's why it's called pro forma. Now guys, so explain in your own words. So explain 3420 is framed for audit of pro forma financial statements. So pro forma financial statements means they are prepared on the basis. So you explain a situation that if any entity wants to come up with public issue, they want to issue prospectus, and any big change happens, hypothetical assumption is taken, and the effect, hypothetical assumption that it is happening on first day, they take that assumption and prepare financial statements outside books of account. That's called pro forma financial statement. Only when these pro forma financial statements are prepared for prospectus, and you need to audit these pro forma financial statements which are presented in the prospectus, in the offer document prospectus, then only this standard gets applicable. And this is not actual thing, or it is not a prospective thing. It is only adjusting the past. Objective is pretty simple. Target for the practitioner is you go and do the audit as per this standard. Check whether the thing is as per criteria. So just like we have financial reporting framework, we have criteria. ICDR regulations 2009 and guidance note is a criteria. It's a benchmark. It is a base principle and format to evaluate whether this pro forma which is prepared is appropriate or not. Go and check it, evaluate it, collect sufficient appropriate evidence, make conclusion, and then make report. That is your target. Objective means what is target set for the person. Okay. Compilation is responsibility of the management. It's called responsible party. It is their responsibility. It is responsible to identify the source of unadjusted information. They are supposed to identify, okay, these are unadjusted financial statement of Flipkart. These are unadjusted financial statement of Meesho. Identify what unadjusted information is required. Collect that information. Then think about the pro forma adjustments. What kind of harmonization adjustments will be required? What kind of adjustment because of this event? Because of this event, goodwill, capital reserve cancellations may happen. Goodwill may happen, capital reserve may happen, cancellations may happen. Because of that, financing related adjustments may happen. That is pro forma adjustment. Okay, present it properly in a format. It is their responsibility. You identify the source of unadjusted information. You think about the pro forma adjustment. You combine them to prepare pro forma financial information, their notes to accounts. It is their responsibility. What is practitioner's responsibility? We are not responsible to compile. Of course, we are not supposed to compile. Our responsibility is to give report on reliability of these financial statements. We have to report whether it is as per the applicable criteria. We have to report whether it is prepared properly. We have to effect whether they have presented and disclosed significant event, the base, the root cause, the significant event, and its all adjustments are properly presented and disclosed. So it is our responsibility not to compile, but to check the pro forma, whether it is as per criteria, whether presentation and disclosure is clearly explaining What was the significant event and transaction? What are its effects? Okay, what are the effects on financing and so on? It's properly presented or not? What steps are involved? First, we need to accept the engagement, plan and perform it, obtain written representation, form opinion, and prepare the report. So, simple step. First, acceptance. Okay. Now, this is important, guys. This can be asked. There has been a question on this. There has been question on this. Now, engagement acceptance. Engagement acceptance. Before you accept such engagement or assignment, very simple thing. Very simple thing. First of all, very famous, whether you are having capabilities and this is a new type of assignment altogether. Are you having knowledge, capabilities, knowledge and skills, competence, time, team, equipment? Okay. Are you having competence and capability to perform such kind of assignment? Do you have knowledge of such kind of assignment, such kind of industry? Will you be able to do it? Do you think the criteria is acceptable? Is it issued by some law or recognized authority? Okay. Is it acceptable? The basic principle and format, is it really going to give proper information? If something is wrong with the criteria, can we avoid misleading information by more disclosures? So, first think about it, whether you have competence and capabilities. Then you think whether the criteria is acceptable. Then, what if the source financial statement of Flipkart and Meesho are modified? If the source information is modified, having EMP, OMP, go and read it. Whether there is any law which prohibits preparing pro forma financial statement on the base of or modified financial statements. If not, you should be careful whether the source is small problems are fine, but if there are adverse lot of problems, the source itself is bad, adverse or disclaimer, don't accept the assignment. What if it is not audited? Go and see whether how simple and complex these financial statements are and whether you will be able to check broadly whether things are appropriate or not, even if they are not auditor reviewed. So, whether you are think about yourself, are you having competence and capability? Whether the criteria is good, whether the source is good, issues with the source. And this was asked, there should be agreement. It is your responsibility to prepare pro forma financial statements. Pro forma financial statements, it's all disclosures. Once you prepare, it is your responsibility to give access to all the information, whatever additional information we ask for. And if you want to do any inquiry, okay, it will be your responsibility. So in totality guys, so if you simply think about the format, first think about yourself. Are you having knowledge? Criteria, where the source is good, where the source financial statements are proper, are they modified, are they having audit or reviewed? Okay, if that is proper, then are they ready to give agreement? Then only you should accept. Planning and performance. Now guys, you cannot rectify this. You need to simply go with the flow. Go with the flow. First, while planning, performing, first you go and read the criteria properly. It should be suitable. You understand the criteria. It should be suitable. You decide the materiality. So you go and first common sense. I will understand entity and its environment. No need to perform regular audit thing, because that should have been done. That was already done by the regular auditors. Okay. So first understand the criteria. Criteria is good, suitable. Decide the materiality. Then understand how the compilation was done, how they prepared it. First understand the criteria and the materiality, then understand the compilation process, how they did it. Then get the evidence about the source, whether the Flipkart and Meesho financial statements are proper. If it is not audited, perform certain procedures to ensure it is complete, accurate information is little bit reliable. Then is it properly extracted? Whatever is the source, properly extracted. Again, source should be appropriate. If it's not audited, some procedure should be performed, extraction. Then adjustments, consistency for harmonization, those are their adjustment due to significant events, goodwill, capital reserve, intercompany, and financing, which is how it was financed. Okay, those adjustments are where, that's most important. Whether the presentation is proper, and go and read prospectus, what information is given related to that in prospectus. Guys, as I said, if I would have been there, first understand the criteria maturity, understand the process, where the source is proper, where the adjustments are proper, calculations are proper, presentation disclosure is proper. That's what we think. Written representation, that give it in writing that applied criteria is appropriate, criteria compliance, that the applied criteria is appropriate, and all pro forma adjustments are also appropriate. Take a written representation. So there should be a written representation. There should be a written representation that all pro forma everything is as per criteria, and all pro forma adjustment is done. If we got all the information properly about the source, about the adjustment, presentation, disclosure, and there are no material misstatements, we are going to give unmodified opinion. If we think that, now modified, there are two situations in modified opinion where relevant law regulation excludes publication of prospectus that contains modified opinion. See, so if, first of all, if there is lack of information, there is no sufficient appropriate information, or something is wrong with the pro forma financial statement, we'll have to modify. Same as audit. If there is a law which says that no, modified first of all pro forma, and that too modified, such financial statement cannot be included in the prospectus, you go and discuss with the responsible party, that law prohibits it. Okay. If responsible doesn't agree to make necessary changes, withdraw from the assignment. We don't have any other option. See, we checked, there were some mistakes, problems, we informed them, they're not ready to change it. Law says that you cannot publish it. You cannot publish modified financial statement with modified opinion. Withdraw. If law is silent about it, give modified opinion with reasons, explain. You can put EMP also here, EMP, and explain what is the matter of emphasis. It is not affecting the opinion on compilation, reference to notes to accounts. Now the report title will be there clearly, independent auditor's report on pro forma financial statement, addressee as per engagement letter, appointing authority. Introductory paragraph, you explain that we have audited a pro forma financial information, and you explain why this pro forma financial information was prepared, what source information for which period, and what criteria was used to prepare it. Introduction, you explain, we have done the audit of pro forma. Now pro forma was prepared because of so and so event, this was the source, this was the criteria which was used for preparation. Then you explain management responsibilities, their responsibility to prepare it as per proper criteria. Practitioner responsibility was to give opinion whether it is as per criteria. We are not responsible to update the original audit report of Flipkart and Meesho. We are not responsible for that. No audit or review, perform audit or review of financial information used in compiling. We have not performed audit of Flipkart and Meesho. No. We have only done audit of how pro forma was prepared. That's it. We have not done audit review. We are not updating its reports. Okay. No assurance on outcome. It is a hypothetical information. Okay, it is not a real thing. We are not talking about whether this thing will happen in future. No, not at all. We have performed it as per 3402. So we give the title, addressee, introduction, management responsibility, auditor responsibility. We have not audited the sources. It is not our responsibility. We are not going to give updated reports on it. We are not going to talk whether this is going to happen. We are going to talk whether the preparation was as per criteria or not. That's it. We are not going to say it's true and fair. No. You will get an MCQ on this. We are not going to talk about true and fair. We are going to say whether it was properly prepared as per criteria or not. That was our responsibility. On reasonable basis, we are going whether it is prepared properly as per criteria, pro forma adjustments are proper, presentation and disclosure is proper, adjustments, overall presentation proper. Only whether it is as per criteria, signature, date, place. We need to put all the documents which prove that it is performed as per law, rules, regulations and standards, and at the end the opinion is enough information to support the opinion that opinion is reliable. Guys, I understand it's a lot of theory. A lot of theory is involved. A lot of things are involved. Just focus. Listen to this lecture once. Focus on the portion which is marked in pink star and focus on 350 plus important questions. That's very important. Focus on 350 plus important question, guys. We'll stop here. We'll meet tomorrow, guys.